The harbor at Alexandria smells of salt, tar, and crushed olives before the sun has fully cleared the horizon. Fishing boats slide out past the breakwater, their hulls dark against a sky just beginning to turn the color of weak wine. On the quay, a merchant stands with a wax tablet in one hand, watching a ship unload sacks of grain from Upper Egypt. He is not a philosopher. He has never heard the word psychology because it will not exist for another 2,000 years. But he is doing something that every great investor after him will also do, whether they know it or not. He is trying to see past the moment in front of him. The grain in those sacks was planted 8 months ago, when no one could know whether the Nile would flood generously or fail. The price he agreed to pay for it was set even earlier than that, in a contract signed before the harvest existed at all. He is not gambling. He has studied the flood records kept by the temple scribes, going back generations. He knows that a low flood tends to follow a high one, that certain winds in a certain month tend to predict a certain kind of year. He has made an estimate, not a guess, and the difference between those two words is the entire subject of this film. Alexandria in this era is the closest thing the ancient world has to a nervous system. Its great library holds copies of nearly every scroll of significance in the Mediterranean and beyond. Astronomy from Babylon, medicine from Kos, mathematics from a Greek world that has already produced Euclid. Merchants here do not simply move goods. They move information and they price it. A trader who hears 3 weeks early that a war has closed a mountain pass in Persia can buy up the spices that are about to become scarce before the rest of the market even knows to be afraid. This is not cunning in the modern sense of trickery. It is patience paired with attention, and it is the oldest form of what centuries later would be called an edge. What is worth noticing, standing on this quay in imagination, is what the merchant does not do. He does not chase the ship that left an hour ago carrying cinnamon at a price he thinks is now too high. He does not panic when a rival undercuts him on linen, because he understands his own reserves well enough to know he can outlast a bad season. He has, without a name for it, something that Charlie Munger would spend the 20th century trying to describe to a room full of shareholders in Omaha. A working knowledge of his own limits, and a refusal to act outside them merely because someone else is acting. This film is not a history of money. Money is simply the scoreboard. It is a history of a much older and stranger subject. The handful of mental habits that let certain human beings see further than the moment they are standing in, resist the emotional current of the crowd around them, and make decisions today that only pay off in a future they will not fully control. Every civilization that has produced surplus wealth has also produced, quietly, a small number of people who mastered this skill. Alexandria had them. Song Dynasty China had them, running rice futures with an actuarial precision that would not be matched in Europe for centuries. Renaissance Florence had them. In the Medici counting houses, where a ledger error could end a family's standing in a single season. And the 20th century, for reasons we will spend the next 3 hours unpacking, produced an unusually concentrated cluster of them in a handful of American cities. Men and women who took the oldest instincts of that grain merchant on the Alexandria docks and turned them into a discipline sharp enough to be studied, and in some cases, cautiously, to be taught. The tools changed, the temperament did not. That is the thesis of everything that follows. Warren Buffett reading annual reports by flashlight as a boy in Omaha, Benjamin Graham rebuilding an entire philosophy out of the wreckage of 1929. Charlie Munger constructing what he called a latticework of models borrowed from a dozen unrelated fields. None of them, in the end, discovered a new way of predicting markets. What they rediscovered, each in their own idiom, was the old grain merchant's habit of mind. Gather more information than the crowd bothers to gather. Wait longer than the crowd is willing to wait. And above all, know the difference between a risk you understand and a risk you merely hope will work out. We begin, appropriately, not with a stock ticker, but with a school of thought that predates the very concept of a market as we know it. A school that met not on a trading floor but in a covered walkway in Athens, and whose central insight about risk would resurface, almost word for word, in the writings of the richest investors of the modern age. Picture Rome before dawn, not the Rome of marble triumph that appears on coins, but the Rome of cold tile floors and oil lamps burning low. In a modest house on the Esquiline Hill, a man in his 60s is already awake, writing. His name is Seneca, and he has more reason than almost anyone alive to think carefully about the psychology of gain and loss, because he has experienced both at an extraordinary scale. He has been one of the wealthiest men in the empire, an advisor to Emperor Nero, and he will eventually be ordered by that same emperor to take his own life. A sentence he will meet, according to the historian Tacitus, with a composure that later generations found almost impossible to believe. Long before that ending, Seneca wrote a set of letters to a younger friend named Lucilius, and buried inside those letters is a piece of thinking that reads, astonishingly, like an investment manual. Seneca advises Lucilius to mentally rehearse loss before it happens, to imagine, in vivid and deliberate detail, exile, poverty, the death of loved ones, the collapse of fortune. This was not pessimism for its own sake. It was a technique, later given the name premeditatio malorum, the premeditation of evils. The purpose was not to live in fear. The purpose was to strip catastrophe of its power to surprise, because it is surprise more than loss itself that produces panic. This single idea, stretched across 2,000 years, is the psychological ancestor of one of the most important habits in the discipline we now call risk management. When Warren Buffett says that the first rule of investing is not to lose money, and the second rule is never to forget the first rule, he is frequently treated as a wit delivering a punchline. He is not. He is restating, in plain American vernacular, exactly what Seneca was telling Lucilius. The investor who has genuinely imagined losing 40% of a position, who has sat with that number until it no longer produces a jolt of adrenaline, is the investor who can hold that position through the very decline that panics everyone else into selling at the bottom. Seneca's contemporaries would have understood the stakes of this better than most modern viewers do, because Rome's economy was not an abstraction to them. It ran on real estate speculation in the provinces, on shipping contracts across a Mediterranean full of pirates and storms, on loans made to foreign kings who sometimes defaulted and sometimes didn't. A senator's fortune could evaporate with a single lost fleet. The philosophy that grew up around this uncertainty was not an academic luxury. It was survival equipment. Marcus Aurelius, who would become emperor roughly a century after Seneca's death, distilled the same idea into a phrase so compact it has outlived the empire that produced it. Some things are within our power, and some are not. Our opinions, our efforts, our choices, these belong to us. The outcome of a battle, the movement of markets, the judgment of other people, these do not, no matter how much we would like them to. Marcus Aurelius wrote his private notebook, what we now call the Meditations, largely while commanding legions on the freezing Danube frontier, trying to hold his own mind steady while an empire's survival hung on decisions he could only partly control. The notebook was never meant for publication. It is a man talking to himself, the way a disciplined trader might keep a private journal not to impress anyone, but to catch his own mind drifting into error. This distinction between what is within your control and what is not turns out to be the single most repeated idea across 4 centuries of great investing, though almost none of the investors who use it trace it back to its Stoic origin. An investor cannot control whether a war breaks out, whether a central bank raises rates, whether a competitor releases a better product next quarter. What can be controlled is the price paid for an asset, the size of the position relative to one's total capital, the depth of research done before committing, and the emotional discipline to hold or sell according to a plan made in a calm moment rather than a panicked one. Seneca would have recognized this instantly. He built an entire philosophy around exactly that division of labor between the controllable and the uncontrollable, and he built it because the alternative, believing that outcomes are within your power when they are not, produces the specific kind of suffering that comes from mistaking bad luck for personal failure or good luck for personal genius. There is a further layer to Stoic thought that maps even more precisely onto the psychology of markets, and it concerns the handling of fortune, a word the Romans used the way we might use the market today, as a force that gives generously and takes without warning, obeying no clear justice. The Stoics did not believe fortune could be tamed. They believed the wise person's task was to build an internal state sturdy enough that fortune's swings, however violent, could not capsize it. Seneca describes wealth itself, when it comes, as something to be held the way a sailor holds a rope in a storm, firmly, usefully, but always ready to let go if holding on would mean going down with the ship. This is not asceticism. Seneca did not give away his fortune, and he was criticized in his own time, not unfairly, for preaching simplicity from inside a very comfortable house. But the criticism misses the actual claim he was making, which was psychological rather than material. It is not the possession of wealth that corrupts a person, but the attachment to it, the fusing of one's identity so completely with an asset that its loss feels like the loss of the self. Modern behavioral science, arriving roughly 19 centuries later, would eventually give this phenomenon a name and a body of evidence. Researchers studying decision-making under uncertainty in the late 20th century found, with remarkable consistency, that human beings do not weigh gains and losses symmetrically. A loss of a given size produces a sharper, more intense emotional reaction than a gain of the identical size produces pleasure. This asymmetry, once it was measured carefully, helped explain why investors so often sell winning positions too early, to lock in the relief of a gain, while holding losing positions far too long, unwilling to accept the more painful feeling of a confirmed loss. The Stoics had no laboratory and no control group. What they had was extremely close, sustained observation of their own minds, and the minds of the people around them in the volatile political and economic life of Rome. And they arrived, through that observation alone, at a working model of the same distortion. This is the deeper reason the Stoic texts have found their way, almost 2,000 years later, onto the bookshelves of hedge fund managers and value investors who would never describe themselves as students of ancient philosophy. Ryan Holiday's popularization of Stoic thought under the banner of "The Obstacle is the Way" found an eager audience in trading floors precisely because traders live inside the exact emotional whether the Stoics were trying to describe: sudden loss, sudden gain, information arriving faster than judgment can process it, and a crowd of other minds around you making the same decisions for the same reasons, which is to say, mostly for bad ones. None of this means the Stoics were investors in any technical sense. They were not calculating discounted cash flows or reading balance sheets, but they had solved, at the level of temperament, the problem that every investor eventually discovers is the actual problem beneath all the technical ones. The math of investing is not particularly difficult. Compound interest is taught to teenagers. What is difficult, and what remains difficult no matter how sophisticated the analytical tools become, is holding a calm and clear mind while your own money rises and falls in ways that feel, moment to moment, like a verdict on your intelligence and your worth. The Stoics built the first serious toolkit for that exact problem. Everything that follows in this film, every ledger, every crash, every calm old man in Omaha reading a newspaper at his desk, is, at bottom, a variation on the same struggle Seneca was describing to Lucilius by lamplight, and the same discipline Marcus Aurelius was rehearsing in his tent on the Danube, trying each morning to want only what was actually his to want. It would take nearly 2,000 years, and one of the worst financial catastrophes in American history, for this ancient discipline of separating the controllable from the uncontrollable to be translated, almost accidentally, into the specific vocabulary of stocks, bonds, and balance sheets. That translation happened not in a palace or a temple, but in a lecture hall at Columbia University, delivered by a man who had watched, from the inside, as an entire generation's fortune turned to ash in a matter of weeks. New York in October of 1929 does not yet know what it is living through. The ticker tape machines in brokerage houses along Broad Street run so far behind the actual pace of trading that by the time a price prints, it is already wrong, already stale, a photograph of a moment that has already collapsed into the next one. Crowds gather outside the New York Stock Exchange, not because anyone can see anything happening. There is nothing to see, no smoke, no fire, nothing but men in dark suits moving quickly between buildings, but because the crowd itself has become news. People are drawn to watch other people's fear the way they might be drawn to watch a storm from a safe window. Except almost no one in this particular crowd is standing at a safe distance. Fortunes are being erased in real time, and everyone on that street either has money in the market or knows someone who does. Benjamin Graham is 35 years old, and he is not merely watching this catastrophe. He is living inside it. Graham had built a reputation over the previous decade as one of the sharper minds on Wall Street, running an investment partnership that used leverage, the practice of borrowing money to amplify returns, a technique that had made the 1920s bull market feel less like an economy and more like a casino with unusually good odds. When the crash arrived, the leverage that had multiplied his gains on the way up multiplied his losses on the way down with the same mathematical indifference. By 1932, after 3 years of declining markets that would eventually erase nearly 90% of the stock market's value from its 1929 peak, Graham's personal net worth had been reduced by a staggering amount. and his fund's investors, people who had trusted him with their savings, had suffered alongside him. It would have been entirely understandable if Graham had simply left the profession in disgrace, as many of his contemporaries did. Instead, he did something rarer and more valuable. He treated the disaster as data. He spent the years that followed not making excuses for what had happened, but conducting what amounts to a forensic investigation into his own errors and the errors of the market as a whole. And the conclusions he reached would become, quite literally, the founding text of an entire school of investing that persists to this day. Graham's central insight, distilled from watching a decade of collective delusion followed by a collective panic, was deceptively simple to state and extraordinarily difficult to practice. A share of stock is not a lottery ticket, and it is not a piece of paper whose value is determined by what other people are willing to pay for it in the next 5 minutes. A share of stock is a fractional ownership claim on a real business, with real earnings, real assets, and real liabilities. And that business has an underlying, calculable worth that exists independently of whatever emotional weather is currently blowing through the trading floor. Graham called this the distinction between price and value. Price is what the crowd is willing to pay today, driven by fear, greed, rumor, and fashion. Value is what the business is actually worth, calculated soberly from its earnings power and its balance sheet. In a rational world, these two numbers would move together closely. In the actual world Graham had just watched collapse around him, they could diverge by staggering amounts, and understanding that divergence was, in his view, the entire game. To make this abstraction usable, Graham introduced one of the most enduring images in the entire literature of finance. A fictional business partner he called Mr. Market. Imagine, Graham asked his students, that you own a small share in a private business, and you have a partner named Mr. Market who shows up at your door every single day offering to either buy your share or sell you more of his, always naming some price. The catch is that Mr. Market is, psychologically, extremely unstable. Some days he arrives euphoric, certain the business is about to conquer the world, and he names a price far higher than any sober analysis would justify. Other days he arrives in despair, convinced the business is doomed, and he names a price so low it borders on the absurd. The genius of this character, and the reason it has survived nearly a century of retelling, is the instruction Graham attaches to it. You are never obligated to transact with Mr. Market on his terms. You are free to ignore him entirely on the days his mood seems unreasonable, and you are free to take advantage of him, buying eagerly when his despair has pushed the price absurdly low, selling when his euphoria has pushed it absurdly high. On the days his mood creates an opportunity. The mistake almost every unsuccessful investor makes, Graham argued, is treating Mr. Market's daily quotation as a piece of information about what the business is actually worth, rather than as a piece of information about Mr. Market's current emotional state. This is, in essence, the Stoic distinction translated into commercial language. Mr. Market's mood is the fortune the Stoics warned against fusing your identity to. It is not within your control, it is frequently irrational, and the wise response is neither to be seduced by its euphoria nor devastated by its despair, but to maintain an independent judgment of value that does not bend to match the crowd's temperature. Graham's second great contribution, born from the same wound, was the concept of a margin of safety. Having watched businesses with genuinely strong balance sheets get dragged down anyway by the sheer panic of the crowd, Graham concluded that an investor could never be perfectly certain of their own analysis, no matter how careful, and therefore needed to build a buffer against being wrong. If your calculation suggested a business was worth a certain amount, you did not pay that full amount. You demanded a significant discount below your own estimate of value, so that even if your analysis contained an error or an unforeseen event damaged the business, there was enough cushion between the price paid and the true worth to absorb the shock. This is, in a very direct sense, the commercial equivalent of Seneca's premeditation of evils. You do not assume your judgment is perfect. You prepare in advance for the possibility that it is not, and you structure your actions so that being wrong does not destroy you. In 1934, Graham published, together with his colleague David Dodd, a book called Security Analysis. And in 1949, he followed it with a more accessible text for the general reader called The Intelligent Investor. These two books, born directly out of the wreckage of 1929, did something that had never quite been done before. They took the ancient, largely intuitive instincts of that grain merchant on the Alexandria docks, patience, skepticism of the crowd, a refusal to confuse price with worth, and rendered them into a systematic, teachable discipline, with specific tests and calculations that a diligent student could actually apply. Graham taught this discipline for years at Columbia Business School, in a classroom that, by the late 1940s, held a young student who took notes with an intensity his classmates found slightly unusual. That student would go on to internalize Graham's framework so completely, and then extend it in directions Graham himself had not fully anticipated, that his name would eventually become, in the popular imagination, nearly synonymous with the entire discipline of value investing. He grew up not in New York but in Omaha, Nebraska, in a house where the newspaper arrived every morning stuffed with numbers that most children his age would have found unbearably dull, and that he found, from a very early age, almost impossible to stop reading. It is to that boy, and to the specific, almost eccentric habits of attention that made him who he became, that we turn next. Omaha, Nebraska, in the winter of 1941, is not a place anyone would mistake for the center of the financial world. The wind comes down off the plains with nothing to slow it, and the streets before sunrise are empty except for delivery trucks and the occasional dog. On one of those streets, a boy of 11 is riding a bicycle with a canvas sack of newspapers slung across the handlebars, working a paper route before school in the particular cold that only the Midwest produces. He is not doing this because his family is poor. His father, Howard Buffett, is a stockbroker and will later become a congressman. He is doing it because he has already, at 11 years old, developed an unusual relationship with numbers, and a paper route is simply one more way to accumulate them. The boy's name is Warren, and by this point in his childhood, he has already purchased his first shares of stock, 3 shares of a company called City Service Preferred, bought jointly with his older sister Doris using savings he had built from selling chewing gum and bottles of Coca-Cola door to door. The stock dropped almost immediately after he bought it, then recovered and rose, and he sold it for a small profit as soon as it did. It then continued climbing, far past the price at which he had sold, and the lesson he took from this was not the one most children would take. He did not conclude that he had made a mistake in the timing. He concluded that he had made a mistake in the impatience, that he had let a small, early gain frighten him into selling before the investment had been given the time it actually needed to prove itself. It is a strange thing for an 11-year-old to internalize, and it would shape the next 8 decades of his working life. What made Warren Buffett unusual as a child was not raw intelligence in the way that word is usually meant. He was not the boy who solved advanced mathematics for its own sake. He was the boy who found business itself, the actual mechanics of how a company made money, endlessly and specifically interesting, the way another child might be endlessly interested in trains or dinosaurs. He read a book from the local library called 1,000 Ways to make $1,000 so many times that he could recite passages from it. He and a friend bought a used pinball machine, placed it in a barber shop, split the earnings with the shop owner, and within a short time had a small fleet of machines placed around Omaha, a business he eventually sold at around 15 for a sum that would be significant even by adult standards of the period. He was reading Moody's stock manuals, thick volumes of raw financial data on hundreds of companies, not because a teacher assigned them, but because he found the ledgers themselves absorbing, the way a novel absorbs someone who loves fiction. This detail matters more than it might first appear, because it goes to the heart of what separates the investors this film studies from the far larger number of people who tried to imitate them and failed. Buffett did not force himself to read annual reports through gritted teeth as a form of discipline. He read them because he was, from a very young age, genuinely fascinated by the question of how a business actually works underneath its stock price. What it sells, to whom, at what margin, against what competition, financed by how much debt. This kind of fascination cannot be manufactured on demand, and its absence is one of the quieter reasons that so many attempts to copy Buffett's methods produce mediocre results. The method was never separable from the appetite that powered it. By 1950, at 19, Buffett had graduated from the University of Nebraska and applied to Harvard Business School, where he was rejected, an event he later described without bitterness as one of the luckiest breaks of his life. Rejected from Harvard, he discovered that Benjamin Graham, whose book The Intelligent Investor he had already read and found more compelling than almost anything he had encountered, was teaching at Columbia. He applied there instead and was accepted. The classroom where Buffett studied under Graham at Columbia in the early 1950s was, by all surviving accounts, an unusual kind of intellectual arena. Graham would present real financial statements from real, sometimes obscure companies, and ask his students to determine what the business was actually worth, stripped of whatever the market happened to be saying about it that week. Buffett, according to classmates and later to Graham himself, was simply better at this exercise than anyone else in the room, consistently, in a way that seemed less like superior technique and more like a different order of attention. Graham gave Buffett the only A+ he awarded in years of teaching the course, a detail Buffett has mentioned in interviews with what still sounds, decades later, like genuine pride. After graduating, Buffett wanted to work for Graham directly, and by his own later account even offered to work for free. Graham turned him down at first, telling him the firm, Graham Newman, simply had no opening. Buffett went home to Omaha, worked for a few years at his father's brokerage, and kept in close contact with Graham by mail in the meantime. When a position finally opened at Graham Newman in 1954, Graham hired him, and Buffett spent 2 formative years working directly alongside the man whose book had already reshaped his thinking, before striking out on his own in 1956 to form the Buffett Partnership with a small group of family and friends who entrusted him with their savings. What Buffett built over the following decade, and then over the following 7 decades, was not primarily a set of stock picks. Individual selections, examined one at a time, are frequently unremarkable in isolation. Ordinary companies bought at ordinary-seeming discounts. What Buffett built was a process, a disciplined, repeatable habit of reading widely, waiting patiently, and acting decisively only when the gap between price and value became, in his own words, wide enough to step over without needing to jump. He has described his ideal temperament for investing as one that requires no exceptional intelligence beyond the ordinary, but does require an unusual and specific kind of emotional control. The ability to remain rational while the people around you are either euphoric or terrified. This is Graham's Mr. Market, internalized so completely that it stopped being a technique Buffett practiced and became something closer to a personality trait. There is a scene worth imagining here, not because it is dramatic in any conventional sense, but because it captures something essential about the temperament this entire film is trying to describe. Picture Buffett in his Omaha office, decades into his career, a room famously unglamorous, lined with stacks of annual reports rather than the trading screens and market data feeds that fill the offices of most of his professional peers. He is not watching a ticker. He does not have a Bloomberg terminal on his desk for most of his career, a fact that visitors have repeatedly found startling. He is reading. He has said that he spends roughly 80% of his working day reading, a habit that traces in an unbroken line back to the boy on the paper route poring over Moody's manuals before school, and to the classroom where Graham taught him to separate a business's true worth from the market's daily opinion of it. The image of Buffett is, in the end, an image of a reader, patient, largely undistracted by noise, willing to look profoundly boring to outside observers in exchange for the compounding advantage that quiet attention provides over time. That word, compounding, deserves its own extended treatment, because it is not merely a mathematical formula that appears in Buffett's letters to shareholders. It became, for him and for the investors who studied him, something closer to a philosophy of life, a way of thinking not just about money, but about knowledge, relationships, and reputation, all of which, it turns out, behave according to strikingly similar rules. There is a version of the story of compound interest that gets told at dinner parties and in personal finance seminars, involving a grain of rice doubled on each square of a chessboard until the total exceeds every grain of rice ever harvested in human history. Or a claim, likely apocryphal, and never traced to a reliable original source, that Einstein once called compound interest the most powerful force in the universe. The story is repeated so often precisely because the underlying mathematics really is startling the first time a person sits with it honestly, whether or not the specific anecdote attached to it is true. Consider 2 ways of accumulating a modest fortune. In the first, a person saves diligently for 40 years, adding a steady sum year after year, and ends with a total that reflects, more or less, the sum of everything they put in. In the second, a person invests a smaller amount, but lets it grow at a rate of return compounding annually over that same span, reinvesting every gain rather than spending it. The second person, assuming reasonable historical rates of return, ends with a total that is not merely somewhat larger than the sum of their contributions. It is several multiples larger, and the overwhelming majority of that final total was generated not in the early years, when the sums were small, but in the final stretch, when the base being compounded had grown large enough for even a modest percentage return to produce enormous absolute gains. Warren Buffett has made this point about his own fortune with disarming directness, noting that the great majority of his net worth was accumulated after he had already passed the age most people associate with retirement, not because his investing skills suddenly improved late in life, but because compounding is, by its nature, a process that produces its most dramatic results in its final stretch, provided the earlier stretches were never interrupted. This last clause, never interrupted, is the entire hidden difficulty of the concept, and it is where mathematics stops being sufficient and psychology takes over. The formula for compound growth is taught in a single class period to teenagers who then promptly forget it, because the formula itself is not the hard part. The hard part is behavioral. Sustaining the discipline required not to interrupt the process during the long, often unglamorous middle stretch when the absolute gains are still modest, and the temptation to sell, to spend, to chase something faster and more exciting elsewhere is at its most persistent. Buffett has described this using an image that has become closely associated with his public identity, that of a snowball rolling down a very long hill. The early distance covered by the snowball adds relatively little mass, because the snowball itself is still small. But if the hill is long enough, and the snow wet enough, and critically, if the snowball is never allowed to stop rolling and melt, the accumulated mass in the final stretch of the hill dwarfs everything gathered in the early going. The title of Alice Schroeder's authorized 2008 biography of Buffett, drawn from his own language, is simply the snowball, and the metaphor endures because it captures something the raw mathematics alone tends to obscure. That the single most important variable in the entire process is not the rate of return, which people obsess over, but the length of the hill, the number of years the snowball is allowed to keep rolling without interruption. This reframes an idea that most people encounter first as a narrow financial concept into something closer to a general law of accumulation, one that applies well beyond a brokerage account. Consider knowledge in a particular field, accumulated through years of reading, in the way Buffett reads. Early knowledge in a subject tends to feel slow and only marginally useful, a collection of disconnected facts that have not yet organized themselves into a workable understanding. But knowledge compounds in a genuinely analogous way to capital, because each new fact does not simply add to the pile. It connects to and illuminates facts already there, and the connections themselves generate insight that no single fact could have produced alone. Charlie Munger, whom this film will examine at length in the chapters ahead, built his entire intellectual method around this specific insight, understanding decades before it became a popular observation that a mind stocked with many interlocking models of how the world works compounds its usefulness, the way capital compounds its value, and for exactly the same underlying reason. Because the growth in any period is a function not of the new input alone, but of the new input acting upon everything accumulated before it. Reputation compounds by the same logic, and this is a point Buffett has made repeatedly to Berkshire Hathaway's managers over the decades, in language stark enough that it has been widely repeated. He has told them that it takes 20 years to build a reputation and 5 minutes to destroy it, and that if they think about that, they will do things differently. This is not merely a moral exhortation. It is the same compounding logic applied to trust rather than to dollars. Trust, accumulated slowly and consistently over a long period, becomes a form of capital in its own right, one that allows a person or a business to secure better terms, attract better partners, and survive setbacks that would sink an entity without that accumulated reserve of goodwill. And like financial capital, it is uniquely vulnerable to a single catastrophic interruption, undoing years of patient accumulation in an instant. What all of this points toward, and what the greatest investors in this film's story understood earlier and more completely than their peers, is that the discipline of getting rich slowly is, underneath the financial vocabulary, a discipline of not interrupting good processes. The snowball does not need to be pushed. It needs primarily to not be stopped. And stopping it, it turns out, is almost never a mathematical failure. It is almost always a psychological one. A moment of panic during a downturn, a moment of boredom during a long, flat stretch, a moment of overconfidence that leads to abandoning a sound process in favor of a flashier one. Understanding why the human mind is so susceptible to exactly these kinds of interruptions, even when the long-term mathematics is not in serious dispute, became, in the second half of the 20th century, the subject of an entirely new field of study, born not on Wall Street, but in a psychology department in Jerusalem and a preschool testing room at Stanford. In the late 1960s, in a small room on the campus of Stanford University, a researcher named Walter Mischel began running an experiment on children roughly 4 years old that would eventually become one of the most cited studies in the history of psychology, and would, decades later, be recognized as directly relevant to the question of why so few people, even when they understand the mathematics of compounding perfectly well, actually manage to practice it. The setup was simple enough to describe in a sentence. A child was seated alone at a table with a single marshmallow placed in front of them and told that the researcher needed to step out of the room briefly. If the child could wait until the researcher returned without eating the marshmallow, they would be given a second one, doubling their reward. If they could not wait, they were free to eat it, but there would be no second marshmallow. The researchers then left the room and observed, through a one-way mirror, what happened next. What happened next, replicated on film across hundreds of children over the following years, is by turns comic and quietly moving to watch. Some children ate the marshmallow within seconds of the door closing. Others visibly struggled, staring at the marshmallow, covering their eyes, sitting on their hands, singing to themselves, physically turning their chairs away from the temptation sitting on the table, employing, without any adult having taught them to, genuine self-regulation strategies to survive the wait. A smaller group managed to hold out for the full interval and claimed the second marshmallow when the researcher returned. The study alone would have been a minor curiosity if Mischel and his colleagues had stopped there. What made it enter the permanent vocabulary of psychology was the follow-up research conducted years and eventually decades later, tracking down many of the original children as adolescents and then as adults. The children who had been able to delay gratification longer in that original testing room, the research found, tended on average to show meaningfully better outcomes across a range of measures later in life, including academic performance and measures of social and cognitive functioning, decades after the original test. It should be said honestly, in the spirit of intellectual precision this film tries to maintain throughout, that later researchers working with larger and more socioeconomically diverse samples in the 2010s found that the strength of this relationship shrinks considerably once a family's economic background is accounted for, and the finding remains genuinely debated within psychology rather than settled. But the core behavioral observation at the heart of it, that the capacity to tolerate a delay between effort and reward varies significantly between individuals and predicts something meaningful about how they navigate the world, has held up as one of the field's more durable insights, and it maps with striking precision onto the central struggle of every investor this film has examined so far. The marshmallow test is, in essence, a miniature and compressed version of the exact choice that confronts an investor every single day the market is open. Sell now and take a certain, immediate, modest gain or hold, tolerate the discomfort of uncertainty, and wait for a potentially much larger reward that is not guaranteed and cannot be collected on demand. Buffett's decision at 11 years old to sell his city's service stock too early, and the lesson he drew from watching it continue climbing without him, is structurally a grown-up version of a child eating the marshmallow. The insight both experiences point toward is the same. The ability to tolerate the discomfort of waiting is not primarily a matter of intelligence or of understanding the mathematics involved. It is a distinct psychological capacity, and it can, encouragingly, be strengthened with practice and with specific mental strategies. In the same way the Stanford children who covered their eyes or sang to themselves were, without knowing the technical vocabulary for it, actively regulating their own attention to survive the wait. Around the same period that Mischel was running his experiments with preschoolers in California, on the other side of the world in Jerusalem, two Israeli psychologists named Daniel Kahneman and Amos Tversky were beginning a collaboration that would, over the following decade, fundamentally reshape the understanding of how human beings actually make decisions under uncertainty, as opposed to how classical economic theory had long assumed they made decisions. Kahneman and Tversky were not primarily interested in finance. Their early work grew out of a broader interest in judgment and probability, conducted largely through carefully designed questionnaires presented to students and colleagues, asking them to choose between different hypothetical gambles, and comparing their actual choices against what a purely rational, mathematically optimal actor would choose. What they found, published across a series of papers through the 1970s, that culminated in the 1979 paper introducing what they called prospect theory, was that human beings deviate from rational, mathematically consistent decision-making in ways that are not random or idiosyncratic, but strikingly predictable and consistent across different people and cultures. The finding most relevant to this film's subject is the one already mentioned in the earlier discussion of Stoic philosophy. Losses are felt roughly twice as intensely as equivalent gains are enjoyed, an asymmetry Kahneman and Tversky termed loss aversion. A person offered a coin flip with a 50% chance of winning $100 and a 50% chance of losing $100 will, on average, decline the bet, even though its expected mathematical value is exactly zero and entirely fair, because the anticipated pain of the potential loss looms larger in the mind than the anticipated pleasure of the equivalent potential gain. This single finding, replicated across decades of subsequent research, explains an enormous amount of investor behavior that would otherwise look simply irrational. It explains why investors so reliably sell their winning positions too early, rushing to convert an unrealized gain into a realized, locked-in one before it can slip away, while simultaneously holding onto their losing positions far too long, unwilling to accept the sharper, more concentrated pain of formally realizing a loss, even when every piece of available evidence suggests the position should be sold. Kahneman would later, in his 2011 book Thinking, Fast and Slow, describe this and related patterns as arising from the interaction of two different modes of thinking within a single mind. One fast, intuitive, and emotionally reactive. The other slow, deliberate, and effortful. And he would argue, with substantial supporting evidence, that the fast, intuitive mode is the default, the one that runs the show unless a person makes a specific, effortful intervention to engage the slower, more deliberate mode instead. What Graham's margin of safety, Buffett's patient reading, and the Stoic premeditation of loss all have in common, viewed through this later behavioral research, is that each of them functions as exactly that kind of deliberate intervention. Each is a structure, built in a calm moment, specifically designed to override the fast, loss-averse, panic-prone mode of thinking before it can seize control during an actual crisis. Kahneman and Tversky gave this ancient struggle, one the Stoics had already intuited from close observation, and Graham had already built defenses against from hard experience, a rigorous experimental foundation, and a vocabulary precise enough to be tested, measured, and eventually taught. The marshmallow sitting on the table in that small room at Stanford, and the falling stock ticker sitting on a trading screen 4 decades later, turn out to be provoking, in the human nervous system, something very close to the identical response. And the rare individuals who can master one turn out, with remarkable consistency, to be the same individuals who can master the other. The question that follows naturally from this is why so few people manage that mastery, given that the underlying psychological mechanisms have now been so thoroughly documented and explained. Part of the answer, as the next chapters will explore, lies not simply in willpower or emotional temperament alone, but in the specific mental architecture certain investors built to make patience easier to sustain, a way of organizing knowledge itself into interlocking frameworks robust enough to make good decisions feel, after enough practice, less like an act of heroic self-control and more like the simple, almost effortless application of a well-built system. That architecture found its fullest expression not in Omaha's most famous investor, but in the sharp-tongued, voraciously well-read business partner who stood beside him for more than 6 decades. There is a grocery store on Farnham Street in Omaha, long since gone, that occupies an unusually large place in the history of American business, not because of anything remarkable that happened inside it, but because of 2 boys who worked there at different times, a few years apart, for the same demanding employer. The store belonged to Ernest Buffett, Warren's grandfather, and among the young clerks who stocked its shelves and worked its counter over the years was a sharp, restless boy named Charlie Munger, born in Omaha in 1924, 5 years before Warren Buffett himself. The two did not become close as children. Munger left Omaha for the University of Michigan, and then, after service in the Army Air Corps during the Second World War, for Harvard Law School, despite never having completed an undergraduate degree, admitted on the strength of a recommendation and his own evident ability. It would not be until 1959, at a dinner arranged by mutual acquaintances back in Omaha, that the two men, by then both adults with their own developing careers, actually met and recognized in each other something rare. What they recognized, according to both men's later recollections, was less a shared set of opinions than a shared cast of mind. Munger, unlike Buffett, had trained as a lawyer and had built a successful practice before turning increasingly toward investing. But the habit that defined him, the one that would eventually make him indispensable to Buffett and to Berkshire Hathaway as something closer to an intellectual partner than a mere business associate, was a voracious, almost compulsive reading habit that ranged far outside the boundaries of finance and law into physics, biology, psychology, mathematics, and history. Munger's own children have said that they rarely saw their father without a book in his hand. And Munger himself, addressing this directly in speeches later in his life, offered an explanation that has since become one of the most quoted lines in the literature of self-education. He said that in his whole life, he had known no wise people across a broad range of fields who did not read constantly, and that there was no substitute for it. He would sometimes illustrate the point by describing Benjamin Franklin, a figure he admired enormously, as a man who essentially educated himself into one of the most capable minds of his era through sheer relentless reading, absent any formal advantage of birth or institution. But Munger's reading was not simply wide for its own sake, and this distinction matters enormously for understanding what made his mind so unusually productive. He was not a dilettante collecting trivia across disciplines to seem well-rounded at dinner parties. He was engaged, deliberately and systematically, in a project he came to describe using a specific and now famous image, the construction of what he called a latticework of mental models. The idea, which Munger articulated most completely in a 1994 talk given to students at the University of Southern California and later expanded upon in various speeches over the following decade, was that no single academic discipline contains enough intellectual tools, on its own, to reliably understand complex real-world situations. A person trained only in economics will see every problem through the narrow lens of supply, demand, and incentive, and will consistently misjudge situations where psychology, biology, or simple physics is doing more of the actual work. A person trained only in psychology will overweight the emotional and social dimensions of a problem, and underweight the hard mathematical or physical constraints bearing down on it just as forcefully. Munger's proposed solution was to deliberately acquire the handful of most powerful, most load-bearing ideas from every major discipline, not the entire academic apparatus of each field, but what he called the big ideas, the small number of core principles that do most of the explanatory work, and to hold them together in the mind simultaneously, ready to be applied to whatever situation actually presented itself, rather than forcing every situation through the single lens of whatever discipline happened to be one's original training. From physics, he drew on the discipline's insistence on working from foundational first principles rather than analogy. From biology, he drew heavily on evolutionary reasoning, on the idea that competitive pressure over time reliably eliminates certain kinds of weakness and reliably rewards certain kinds of adaptation. A lens he found directly transferable to understanding why some businesses survived brutal competition for a century while others, seemingly just as promising at the outset, collapsed within a decade. From psychology, he drew an entire catalog of the specific, predictable ways human judgment goes wrong under specific conditions. A catalog he would eventually organize into one of his most influential pieces of thinking, examined in the chapter that follows this one. From mathematics, he drew a persistent respect for the power of compounding and the danger of exponential processes that most human intuition badly underestimates. A set of instincts that connects directly back to the discussion of compounding in the previous chapter. The image of the latticework itself is worth sitting with, because it explains something important about why this approach produces better judgment than deep expertise in any single field alone. A fact or a model held in isolation is, in Munger's own words, of limited use, because a mind holding only isolated facts has no way of knowing which fact is actually relevant to the situation in front of it. But facts and models held in a lattice, connected to one another across disciplinary boundaries, illuminate each other, a pattern noticed in evolutionary biology about why certain adaptations are stable while others are quickly outcompeted, turns out to shed real light on why certain business strategies persist profitably for decades while others, however clever they seem on paper, get rapidly copied and competed away. A principle from physics about irreversible processes turns out to shed light on why certain financial decisions, particularly those involving debt and leverage, carry risks that are not merely large but qualitatively different in kind from ordinary risks, because they can foreclose entire future paths rather than simply reducing the odds of any one particular outcome. This is, in a real sense, an extension of the ancient philosophical tradition this film opened with, though Munger himself drew as much or more from Franklin and from 20th century psychology as he did from the classical Stoics. What connects him back to Seneca and Marcus Aurelius is not any specific doctrine, but the underlying method, the conviction that clear thinking is a discipline that must be actively built and maintained through deliberate practice, that the untrained mind defaults to error in predictable ways, and that the antidote is not raw intelligence, which Munger repeatedly and somewhat provocatively argued was overrated as a predictor of good judgment, but a trained, structured, actively maintained way of processing information that catches errors before they become expensive. Munger's reputation within Berkshire Hathaway, and within the wider community of investors who studied the partnership he built with Buffett over more than 6 decades, was as the partner willing to say the blunt, uncomfortable thing that Buffett's more diplomatic temperament sometimes softened. Buffett himself, in numerous shareholder letters and interviews over the decades, credited Munger directly with pushing him to evolve beyond Graham's original framework, away from buying purely statistically cheap, mediocre businesses purely because the numbers looked inexpensive, and toward a more sophisticated appreciation for paying a fair price for a genuinely wonderful business with durable competitive advantages. A shift that Buffett has said, in plain terms, made Berkshire Hathaway dramatically more successful than it would have been under the earlier, narrower approach alone. This shift from cheap and mediocre to fair price and wonderful is itself a direct product of the latticework in action, because recognizing a durable competitive advantage requires exactly the kind of cross-disciplinary thinking, drawing on economics, psychology, and a close reading of a business's specific history, that a purely numbers-driven, single-lens approach to valuation tends to miss entirely. Underlying all of this technical apparatus, though, was a specific mental habit that Munger returned to again and again across decades of speeches and interviews as, in his own estimation, the single most useful trick in his entire intellectual toolkit. It was not a discipline drawn from economics or biology or physics directly, but a method borrowed, by his own account, from a 19th century German mathematician and repurposed for the entirely different problem of making better decisions under uncertainty. It is to that specific method and the strange but remarkably effective habit of thinking backward that the next chapter turns. In the early 19th century, a German mathematician named Carl Gustav Jacobi built a formidable reputation for solving problems in mathematical analysis that had resisted other approaches, and he became known, among students of mathematics, for a particular piece of working advice he gave regarding difficult problems. The instruction, rendered into English over the generations since, is usually given as a short, almost blunt phrase: "Man muss immer umkehren," or "invert, always invert." Jacobi's own point was primarily mathematical and technical, concerning the frequent usefulness of restating a difficult problem in its inverse form when the original formulation resisted solution. But the phrase itself, stripped of its original narrow mathematical context, would go on to have an extraordinary second life almost 2 centuries later, in the hands of a lawyer-turned-investor in Omaha, Nebraska, who adopted it as something close to a personal motto. Charlie Munger's use of inversion, elaborated across dozens of speeches over his later decades, was not primarily mathematical. It was a general-purpose technique for approaching hard problems in business, in investing, and in life more broadly, and its power lies in a fact about human cognition that is simple to state, but easy to forget in the moment it actually matters. It is very often significantly easier to identify the ways a goal can be destroyed than to directly identify the specific path that leads to achieving it. Ask a person how to build a great and durable business, and the question tends to produce vague, aspirational answers, because the space of possible good outcomes is enormous and underspecified. Ask that same person how to destroy a currently thriving business, and the answers come quickly, specifically, and with real conviction. Take on excessive debt right before an economic downturn. Alienate your most loyal customers to chase a slightly larger market in the short term. Let internal politics and empire building replace a genuine focus on serving the customer. Hire people you cannot trust and then fail to build any system of accountability to catch it. The list, once a person begins actually generating it, tends to be specific, vivid, and immediately actionable, in a way that the equivalent forward-looking list of positive advice rarely manages to be. Munger's insight was to take this observation seriously as a working method, rather than treating it as a mere rhetorical curiosity. If it is genuinely easier to identify the reliable paths to failure than the reliable paths to success, then a significant part of the work of building a successful investment career, or a successful business, or for that matter a well-lived life, can be accomplished simply by rigorously identifying every reliable path to failure, and then systematically avoiding all of them, rather than exhausting oneself in the harder and more uncertain project of trying to directly engineer success from first principles. He described this most memorably in a story he liked to tell about a fictional practical man who was asked how he might achieve happiness in life. The man responded that he had no idea how to become happy, but that he knew with great confidence exactly how to guarantee a miserable one, through envy, resentment, unreliability, and a refusal to learn from the experience of others who had gone before, and that his entire practical strategy for living was therefore to identify that list with total honesty, and then spend his life carefully avoiding every item on it. This inverted approach to problem solving turns out to map with unusual precision onto the specific challenge of investing, where the asymmetry between the difficulty of finding a great investment and the relative ease of identifying a terrible one is especially stark. Warren Buffett's famous first rule, discussed in an earlier chapter, that the primary objective is not to lose money, is itself a piece of inverted thinking, dressed in Buffett's characteristically plain vocabulary. Rather than asking, as most inexperienced investors instinctively do, which stock offers the single greatest possible upside, Buffett and Munger built their entire process around the inverted question: which investments carry a meaningful risk of permanent, unrecoverable loss, and how can those specific investments be identified and avoided with near-total reliability, even at the cost of missing out on some genuinely spectacular winners along the way? This is not a philosophy of timidity. Berkshire Hathaway, across its history, made extraordinarily large and concentrated bets when the opportunity clearly warranted it. But the process by which those bets were selected began, in nearly every documented case, with an exhaustive search for reasons the investment might fail catastrophically. And only after that search came up largely empty did the partnership proceed to size the position aggressively. The technique extends usefully well beyond individual investment selection into the broader architecture of how a business itself should be run, and Munger applied it there just as rigorously. Rather than asking how Berkshire Hathaway's various subsidiary businesses could each be made maximally efficient through active, centralized management intervention, a question that invites an almost unlimited amount of well-intentioned, but ultimately value-destroying meddling, Munger and Buffett instead asked the inverted question: what specific practices, common at other large conglomerates, most reliably destroyed value and demoralized capable operating managers over time? The answers they arrived at: excessive headquarters bureaucracy, constant reorganization for its own sake, a corporate culture that punished honest reporting of bad news, compensation structures that rewarded empire building over profitability, became, in effect, a photographic negative from which Berkshire's own famously decentralized, low-intervention management structure was directly derived. Berkshire's headquarters, for most of its history, employed a strikingly small central staff, overseeing a sprawling collection of subsidiary businesses, a structure that makes far more sense once it is understood as the deliberate, inverted avoidance of a very specific and well-documented list of large company failure modes, rather than as some positively engineered ideal dreamed up from a blank slate. There is a broader psychological reason inversion works as well as it does, one that connects back to the discussion of Kahneman and Tversky's research in the previous part of this film. The human mind, operating in its fast, intuitive mode, is generally quite good at pattern recognition when the pattern being recognized is danger. A legacy, in all likelihood, of a very long evolutionary history in which failing to notice a genuine threat carried far steeper consequences than failing to notice a genuine opportunity. Asking the mind to identify how something might catastrophically fail plays directly to this well-developed, evolutionarily ancient strength. Asking the same mind to positively construct, from nothing, the precise pathway to an unprecedented success asks it to do something it is, by comparison, considerably less naturally equipped to do well. Because success at any genuinely ambitious scale is, almost by definition, something that has rarely, if ever, happened in exactly that form before, leaving the intuitive, pattern-matching mind with far less relevant precedent to draw upon. Munger's habit of inversion, in the end, was never really about pessimism, despite occasionally being mistaken for it by observers unfamiliar with the underlying logic. It was a targeted exploitation of an asymmetry in how reliably the human mind can reason about failure compared to how reliably it can reason about success. Deployed in service of a discipline Munger considered, by his own repeated public statements, considerably more valuable over a full lifetime than any amount of raw cleverness or positive genius. That discipline, the deliberate cultivation of consistent good judgment through the patient avoidance of known and well-catalogued errors, became the organizing theme of what is probably Munger's single most influential and most widely studied piece of intellectual work, delivered originally as a speech at Harvard University and expanded upon for the rest of his life. It is to that specific body of thinking, on the psychology of human misjudgment and the deliberate cultivation of what Munger called being consistently not stupid, that the final chapter of this part now turns. In 1995, Charlie Munger stood before an audience at Harvard University and delivered a talk that would, over the following decades, circulate far beyond the room in which it was originally given, passed from hand to hand, transcript to transcript, among investors, executives, and students of decision-making who found in it something they had not quite encountered in this organized a form before. The talk was later published under the title The Psychology of Human Misjudgment, and in it, Munger laid out, in his characteristically blunt and occasionally caustic style, a catalog of roughly 24 distinct tendencies in human cognition that reliably produce bad decisions, drawn from psychological research, from his own decades of direct observation running businesses and evaluating investments, and from a lifetime of watching intelligent, well-credentialed people make catastrophic errors that, in retrospect, followed remarkably predictable patterns. The specific list of tendencies Munger cataloged: reward and punishment superresponse tendency, the tendency for incentives to shape not merely behavior but genuine belief, social proof tendency, the deeply ingrained pull to imitate the behavior of the surrounding group, especially under uncertainty, and roughly 20 others, ranging from excessive self-regard to a stubborn resistance to changing one's mind once a public position has been staked out, is less important, for the purposes of this film, than the underlying philosophy that organized the entire project. Munger was not primarily interested in cataloging human folly as an academic exercise. He was building a practical checklist, the same way a pilot uses a pre-flight checklist, not because any individual item on it is likely to be the source of disaster on any given flight, but because the systematic, unglamorous discipline of checking every item every time catches the rare but catastrophic error that an unaided, confident memory would otherwise miss. This connects to what might be the single most quoted and most philosophically distinctive statement Munger made across his long public career, a line he returned to in various forms across many decades of speeches, that he had got to where he was in life not by any particular effort to be brilliant, but by a persistent, disciplined effort to be, in his own words, consistently not stupid, and that this approach, unglamorous as it sounded, had proven to carry an enormous long-term advantage over people who spent their energy, instead, chasing flashes of brilliance, while remaining exposed to the same predictable, well-documented errors that eventually catch up with almost everyone who does not actively guard against them. The distinction Munger was drawing here is worth dwelling on carefully, because it runs directly against a deeply held cultural assumption about what produces extraordinary success. An assumption that shows up constantly in popular narratives about great investors, entrepreneurs, and business leaders, which tend to focus almost exclusively on moments of singular, brilliant insight. The one trade, the one bet, the one flash of contrarian genius that made someone's fortune. Munger's own life and record, and Buffett's alongside it, suggest a substantially different and considerably less cinematic account of how such fortunes are actually built. The overwhelming majority of the decisions made across a 6-decade investing career are not moments of brilliant insight at all. They are simply the accumulated result of avoiding an enormous number of specific, identifiable, well-cataloged mistakes that a large fraction of other market participants, lacking either the awareness or the discipline to guard against them, walk directly into. Consider the tendency Munger called social proof, perhaps the most economically consequential of all the biases on his list, because of how directly it explains the recurring pattern of speculative bubbles that stretches from the Dutch tulip mania of the 1630s through the dot-com bubble of the late 1990s and beyond. A pattern this film will examine in close detail in the chapter on crowd psychology later on. Human beings, under conditions of genuine uncertainty, look instinctively to the behavior of the people around them for guidance on what to do, a tendency that made excellent evolutionary sense across most of human history. When the accumulated collective judgment of a surrounding group, built from generations of hard-won local experience, was frequently a more reliable guide to action than any single individual's independent reasoning could be. But this same instinct, transplanted into a modern financial market where an entire crowd can become simultaneously and confidently wrong, in perfect synchrony, about the value of a specific asset, becomes a liability of the first order, actively amplifying rather than correcting the very errors it evolved to help prevent. Simply knowing about this tendency, keeping it consciously on a mental checklist, and consistently asking, in any moment of strong crowd enthusiasm or crowd panic, whether one's own conviction is actually independently derived or is merely borrowed unconsciously from the surrounding social temperature, constitutes a large fraction of the entire practical value of Munger's checklist-based approach to avoiding error. It is worth being honest, in the spirit of intellectual rigor this film has tried to maintain throughout, that Munger's catalog of misjudgments was assembled primarily through personal observation and wide reading, rather than through the kind of formal, peer-reviewed experimental methodology that produced Kahneman and Tversky's prospect theory. Some of the specific tendencies on his list map closely onto rigorously established findings in academic psychology, and some are closer to seasoned, shrewd folk wisdom, gathered from decades spent watching real human beings make real decisions with real money at stake, than to laboratory science in the strict sense. Munger himself, characteristically, would likely not have minded this distinction being drawn, since his entire project was explicitly practical rather than academic in its aims, concerned with what actually improved real-world decision-making rather than with satisfying the formal standards of a peer-reviewed journal. What emerges from placing Munger's checklist alongside the material examined earlier in this film is a coherent, cumulative picture of what disciplined thinking about risk and decision-making actually requires, built up in layers across 2,000 years. The Stoics established the foundational distinction between what can and cannot be controlled, and developed the practice of premeditating loss so that catastrophe, when it eventually arrives without the added damage of pure shock. Graham translated this discipline into the specific vocabulary of business valuation, building the margin of safety as a structural defense against the inevitability of being occasionally wrong. Buffett demonstrated, across an unusually long and well-documented career, what sustained, undistracted patience actually looks like in daily practice, embodied in 80% of a working day spent reading rather than reacting. Kahneman and Tversky supplied the rigorous experimental foundation, explaining precisely why patience and rational risk assessment are so difficult for the human mind to sustain without deliberate intervention. And Munger, drawing on all of it and adding his own wide, cross-disciplinary reading, built the most complete practical checklist yet devised for catching the mind in the specific act of going wrong, before that error could compound, quietly and invisibly, into a catastrophic and irreversible loss. None of this, it should be said clearly, made either Munger or Buffett immune to error. Both men, across their long careers, made investments that failed and decisions they later described, in refreshingly direct terms during Berkshire's annual shareholder meetings, as outright mistakes. The claim this film is making is a more modest, and in some ways, a more useful one than any suggestion of infallibility, that the specific, cultivated habit of actively searching for one's own errors, rather than defensively rationalizing them away after the fact, is itself the rarest and most valuable skill in the entire discipline, considerably rarer and more valuable than any single flash of investment brilliance could ever be on its own. But avoiding error, however disciplined the process, cannot by itself protect an investor from a very different kind of danger, one that does not arise from any failure of individual judgment at all, but from the sheer, overwhelming force of collective human emotion moving through a crowd of otherwise reasonable people simultaneously. It is to that older and in some ways more frightening phenomenon, the psychology of panic and mania as it moves through an entire market at once, that this film turns next, beginning with a trader whose spectacular gifts for reading a market's mood were matched, tragically, by an equally spectacular inability to discipline his own. Boston in 1891 is a city of telegraph wires and horse-drawn carriages, and inside a brokerage office on its edge, a 14-year-old boy stands at a chalkboard, chalk in hand, updating stock prices as they arrive by ticker tape. His name is Jesse Livermore, and he has run away from his family's farm in Massachusetts against his father's wishes, having decided, with a conviction unusual in a boy that age, that a life spent behind a plow was not the life he intended to live. The job of board boy, transcribing prices onto a chalkboard for customers to watch, pays him little, but it gives him something far more valuable to a mind like his, an unbroken, hour-by-hour view of how prices actually move, and an early, almost obsessive fascination with the patterns hidden inside that movement. Livermore began keeping a small notebook, recording prices and his own predictions about where they would go next, testing his intuitions against the outcomes before he ever risked a dollar of his own money. By his own later account, he found that his predictions, tested this way over time, were right with startling frequency, and he began trading in what were known as bucket shops, informal and often illegal betting parlors that let a customer wager on the direction of a stock's price without actually purchasing the underlying shares, functioning less like a brokerage than like a casino built around the stock ticker. Livermore was so successful at reading these short-term price movements that he was eventually banned from bucket shop after bucket shop across New England, the proprietors unwilling to keep accepting bets from a teenager who kept winning. By his early 20s, Livermore had moved to New York and begun trading on the actual exchanges, and it was here, across the following 3 decades, that he built one of the most spectacular and most cautionary careers in the entire history of American finance. He earned the nickname the Boy Plunger for the size and boldness of his bets, and he demonstrated, on multiple occasions, an almost uncanny gift for reading the psychology of a market at its turning points. In 1907, during a financial panic that threatened to cascade into a full-scale collapse of the American banking system, before J.P. Morgan personally organized a rescue, Livermore correctly identified that the market was overextended and sold short aggressively, reportedly earning around $1 million, an almost unimaginable sum for a man still in his 20s, in a single day of trading. He would repeat a version of this feat, on a vastly larger scale, in the autumn of 1929, correctly anticipating the crash that devastated Benjamin Graham and an entire generation of investors, and building a short position that, by some contemporary estimates, earned him roughly $100 million, as the market that ruined so many others made him extraordinarily rich. If the story ended there, Livermore would occupy a very different place in the history this film is telling, remembered as a supreme technical genius of market timing. But the story does not end there, and the reason it does not is the entire point of including him in this account at all. Livermore made and lost several enormous fortunes across his lifetime, not once but repeatedly, declaring bankruptcy on more than one occasion after having already proven, beyond any reasonable doubt, that he possessed a genuine and rare talent for reading market psychology, the pattern that emerges from his own later reflections, and from the fictionalized but closely autobiographical account published under the title Reminiscences of a Stock Operator, ghostwritten by the journalist Edwin Lefevre, based extensively on interviews with Livermore and widely understood to represent his own voice and experience, is a pattern not of insufficient skill, but of insufficient discipline. Livermore himself, in the book's own words, repeatedly identified his greatest enemy not as the market but as himself, describing a persistent tendency to abandon his own carefully developed trading rules the moment a position began moving against him, or conversely, to grow overconfident and dramatically oversized his bets after a string of successes, precisely the kind of behavior that the Stoic and value investing frameworks examined earlier in this film. were built specifically to guard against. There is a particular tragedy embedded in Livermore's story that separates him meaningfully from the other figures examined so far, and it concerns the relationship between technical skill and psychological stability. Livermore was not lacking in intelligence, and he was not lacking in market insight. His record of correctly anticipating two of the most significant financial panics in American history proves that beyond serious dispute. What he lacked, by his own repeated admission across interviews and in the reflections attributed to him in reminiscences, was the capacity to apply his own hard-won rules consistently, particularly under the emotional pressure of either a large loss or, just as dangerously, a large and intoxicating win. He wrote in one of the book's most frequently quoted passages that a stock operator's biggest enemy is always working inside his own head, and that the market itself, however difficult, was never really the primary opponent. This is a strikingly direct restatement, arrived at independently through decades of brutal personal experience rather than through philosophical study, of exactly the distinction Marcus Aurelius drew between what is within one's control and what is not. Livermore could control his own trading rules. He could not, with any reliability, control his own emotional response to breaking them, and that gap, over a career spanning 4 decades, eventually proved catastrophic. His later years were marked by severe depression, the dissolution of relationships, and a final, ruinous collapse of his fortune in the 1930s from which he never fully recovered, either financially or personally. In November of 1940, having lunched at the Sherry Netherland Hotel in Manhattan, Livermore took his own life. It is worth pausing on this ending not for its drama, but for what it teaches, honestly, and without sensationalizing a genuine human tragedy touched by what would today likely be recognized as serious, unaddressed mental illness. Livermore's story stands, within the larger arc of this film, as the clearest possible demonstration that raw analytical talent, even talent of a genuinely historic order, is not sufficient on its own to produce a durable, well-lived relationship with money and with risk. The discipline examined in the previous chapters, Graham's margin of safety, Buffett's patient temperament, Munger's checklist against known cognitive errors, exists precisely because talent alone, unaccompanied by that discipline, has a well-documented tendency to eventually destroy even its most gifted possessor. Livermore correctly diagnosed his own problem with remarkable clarity and eloquence. He simply could not, across an entire lifetime of trying, consistently solve it, and the difference between diagnosing a psychological weakness and actually overriding it in the heat of an active, live position turns out to be one of the widest and most consequential gaps in the entire discipline this film is exploring. That gap becomes even more visible and even more dangerous when it stops operating inside a single mind and begins operating across an entire crowd simultaneously. Each individual investor's private errors reinforcing and amplifying the errors of everyone around them, until the resulting collective movement takes on a character and a violence that no single participant, however disciplined, fully intends or fully controls. In the Netherlands during the winter of 1636 and into the early months of 1637, a striking transformation took place around an ordinary flower. Tulip bulbs, particularly rare variegated varieties whose distinctive striped petals were, unknown to anyone at the time, actually the result of a mosaic virus infecting the bulb rather than a stable, breedable trait, began trading at prices that, in retrospect, defy any rational relationship to the flower's actual usefulness or scarcity. Contracts for a single rare bulb reportedly changed hands for sums equivalent to the price of a substantial house in Amsterdam, traded not by professional merchants alone, but by craftsmen, farmers, and ordinary townspeople, swept up in a speculative fever that historians would later come to call tulip mania. In February of 1637, the market for these contracts collapsed with comparable suddenness, leaving many of the participants who had bought near the peak holding contracts worth a small fraction of what they had paid. The Scottish journalist Charles Mackay, writing 2 centuries later in his 1841 book Extraordinary Popular Delusions and the Madness of Crowds, used the tulip episode, alongside the South Sea bubble that convulsed British financial markets in 1720, and the Mississippi Company bubble that did comparable damage in France around the same period, to argue for a general thesis about crowd behavior that would echo through the subsequent history of financial panics right up to the present day. Mackay's specific numerical claims about the tulip mania have been challenged by later economic historians, some of whom argue the scale of the episode and its broader economic damage were considerably more modest and more confined to a narrow speculative community than Mackay's vivid account suggests. But the underlying psychological pattern he was describing, whatever its precise magnitude in the Dutch case specifically, recurs with remarkable consistency across financial history in episodes whose scale is not in any serious historical dispute. The South Sea Bubble, the railway mania that swept Britain in the 1840s, the speculative excess of the late 1920s that Benjamin Graham lived directly through, the dot-com bubble of the late 1990s, and the mortgage-fueled excess that preceded the 2008 financial crisis. What connects these otherwise wildly different episodes, separated by centuries and involving entirely different assets, is a common underlying mechanism that the French social psychologist Gustave Le Bon attempted to formalize in his own influential 1895 book, simply titled The Crowd. Le Bon argued that an individual absorbed into a crowd undergoes a genuine psychological transformation, becoming, in his account, considerably more suggestible, more emotionally reactive, and less capable of independent, critical reasoning than that same individual would be when making a decision alone. Le Bon's broader theories about crowds have been used, at various points across the 20th century, in ways their author likely did not fully anticipate, and that later scholars have rightly scrutinized and critiqued, particularly regarding his sweeping and now clearly outdated claims about the psychology of different populations. But the narrower observation at the heart of his work, that individual judgment tends to degrade under the specific social pressure of a visibly moving crowd, has held up considerably better, and it connects in a direct, traceable line to Charlie Munger's own catalog of misjudgment discussed in the previous part of this film, specifically to what Munger termed social proof tendency, the deeply rooted human instinct to look to the behavior of others as a primary guide to one's own action under uncertainty. A financial bubble, examined through this lens, is not primarily a story about an asset. It is a story about a specific feedback loop operating on human attention and human confidence. In its early stage, a small number of genuinely well-informed participants recognize real value in an asset, whether tulip bulbs with a striking and fashionable appearance, or 3.5 centuries later, internet companies with genuinely transformative technology, and they begin buying. Prices rise, and that rise itself becomes a piece of information, visible to a much wider circle of observers who were not part of the original, careful analysis. Those observers reasoning, often unconsciously, that a rising price must reflect some genuine underlying value they themselves may simply lack the specialized knowledge to fully appreciate, begin buying as well, not because they have independently verified the asset's worth, but because the crowd's own prior movement has become, in their minds, a form of evidence. This is precisely the mechanism Le Bon was describing, and precisely the mechanism Munger's social proof tendency names in more contemporary psychological language. Each new buyer's participation further validates the price rise in the eyes of the next prospective buyer, and the loop accelerates, price and participation reinforcing each other in a spiral that has, by its later stages, largely detached itself from any sober analysis of the underlying asset's actual worth in the sense Benjamin Graham would have insisted on. The reversal, when it eventually comes, operates through the identical mechanism running in the opposite direction, and it typically arrives with considerably more violence and considerably more speed than the original ascent, for reasons that connect directly back to the earlier discussion of Kahneman and Tversky's research on loss aversion. Because losses are felt roughly twice as intensely as equivalent gains are enjoyed, a market moving downward tends to generate a more urgent, more immediate psychological pressure to act, specifically to sell, than a market moving upward generates pressure to buy. A crowd in the grip of collective euphoria moves with a kind of giddy, self-reinforcing momentum. A crowd in the grip of collective panic moves considerably faster, propelled by a more primal and more urgent form of fear. The specific fear of watching one's own accumulated capital visibly disappear in real time while everyone around behaves as though disaster is now not merely possible, but actively, immediately underway. It is precisely this mechanism, this specific and well-documented tendency of markets to swing between extremes of collective euphoria and collective despair, That creates the very opportunity Benjamin Graham's Mr. Market metaphor was designed to help investors exploit rather than fall victim to. A disciplined investor who understands the actual mechanics of a crowd panic, understands that the mechanism driving the price collapse is social and psychological contagion, rather than, in most cases, any equally sudden and equally severe collapse in the underlying businesses being sold, is positioned to do something that feels, in the moment, almost unbearably difficult and counterintuitive. To buy precisely when the crowd's fear has reached its most extreme and most convincing pitch, on the reasoned judgment that the fear itself, however psychologically overwhelming, is not reliable information about the business's actual long-term worth. No investor in the modern history of this discipline built an entire, extraordinarily successful career around exploiting exactly this specific insight with more consistency, or with more genuine courage under genuinely terrifying conditions, than a devout, soft-spoken man from rural Tennessee, who made his first legendary fortune not during some calm and comfortable moment, but in the opening weeks of the Second World War, at a moment when the entire world, reasonably enough, believed catastrophe was only beginning. In September of 1939, as German forces crossed into Poland and the great powers of Europe began, one by one, declaring a war that would eventually claim tens of millions of lives, the mood on Wall Street was, understandably, one of near total dread. American stock prices, along with markets across much of the world, were falling on the reasonable assumption that a global war would bring economic devastation, disrupted trade, destroyed industry, and years of hardship. It was at precisely this moment, with the newspapers full of invasion maps and mobilization orders, that a 26-year-old investor named John Templeton did something that struck many of his contemporaries as either reckless or slightly unhinged. Templeton borrowed money, $10,000, a genuinely significant sum for a young man in 1939, and instructed his broker to purchase 100 shares of every single stock listed on the New York Stock Exchange that was trading at a price of $1 per share or less, a list that ran to well over 100 different companies. Crucially, and this detail is central to understanding the specific character of the discipline Templeton was practicing, he did not exclude the companies on that list that were already in bankruptcy or clearly heading toward it. He bought a small position in essentially all of them, on the theory that a war economy, whatever short-term devastation it brought, would eventually generate enormous industrial demand, and that even companies currently on the edge of collapse might survive and recover far more often than the market's current extreme pessimism was pricing in. Of the roughly 104 companies on his list, only a small handful ultimately went to zero. Templeton held the rest for years, and when he eventually sold, the portfolio had multiplied his original investment several times over. An extraordinary result achieved by deliberately buying into precisely the moment of maximum collective fear rather than waiting, as most investors instinctively do, for clearer and calmer conditions that, by the time they finally arrive, have already erased the very discount that made the original purchase so attractive. Templeton would go on to build one of the most successful and longest-running careers in the history of professional investing, eventually founding the Templeton Growth Fund and becoming one of the earliest and most committed advocates of what was then a genuinely unusual idea, that a disciplined American investor should look not merely at American companies, but across the entire globe for the specific, underpriced opportunities that a purely domestic focus would systematically miss. He built much of his later career and notably relocated his residence to the Bahamas in part, by his own account, specifically to remove himself physically from the dense, anxious, day-to-day social atmosphere of Wall Street, reasoning that geographic and social distance from the crowd's constant emotional temperature made genuinely independent, contrarian judgment considerably easier to sustain over a long career. A decision that reads, in light of everything examined earlier in this film about crowd psychology and social proof, as a remarkably practical and deliberate structural defense against exactly the contagion mechanism Gustave Le Bon and Charlie Munger both separately identified as so corrosive to independent thought. Templeton distilled his own investment philosophy into a small number of maxims that have circulated widely in the decades since, and two of them in particular deserve close attention here because of how precisely they connect to and extend the material examined earlier in this film. The first, offered as a caution against exactly the kind of self-reinforcing crowd euphoria described in the previous chapter, held that the four most dangerous words in all of investing are the phrase, "This time it's different," a warning against the specific and recurring delusion, present in every speculative bubble from the Dutch tulip mania forward, that some genuinely novel technology or economic circumstance has permanently suspended the older, more painful lessons of financial history. Templeton was not arguing that meaningful technological and economic change never occurs, only that markets consistently, reliably overestimate how completely such changes suspend the underlying psychological patterns of greed and fear that drive prices to irrational extremes in both directions. The second and more famous of Templeton's maxims describes, with unusual precision, the entire emotional arc of a market cycle in a single sentence. That bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Read alongside the mechanism described in the previous chapter. This single sentence functions almost as a practical field guide to the specific psychological terrain an investor must learn to recognize and navigate. The most profitable moment to begin buying, in Templeton's own well-documented practice, arrived not when the outlook was reassuring and confirmed by a comfortable consensus, but at what he came to call the point of maximum pessimism, the precise moment when fear has become so totalizing and so widely shared across the crowd that almost no one remains psychologically capable of buying at all. A condition that, by the basic logic of supply and demand operating on a market that has been emptied of willing buyers, reliably produces the deepest and most durable discounts to genuine underlying value. This is, in the end, Graham's Mr. Market metaphor and the stoic discipline of separating controllable judgment from uncontrollable fortune, taken to their fullest and most demanding practical conclusion. It is a considerably harder thing to actually practice than it is to state as a maxim, because the point of maximum pessimism does not arrive labeled as such. It arrives disguised as what genuinely, viscerally feels, in the moment, like the end of the world, accompanied by newspaper headlines, expert commentary, and the visible fear of nearly everyone in one's own immediate social and professional circle, all pointing toward the same apparently reasonable conclusion that further loss is not merely possible but overwhelmingly likely. Templeton's specific genius, examined across a career spanning more than half a century and covering markets on every populated continent, was not a superior ability to predict when wars would end or when economies would recover. It was a superior, deliberately cultivated ability to act with genuine conviction directly against the strongest, most persuasive, most universally shared emotional current of the moment, precisely because he had built, well in advance of any actual crisis, both the philosophical framework and the physical and social distance required to trust his own independent judgment over the crowds. The remaining chapters of this film turn from the raw, elemental forces of fear and crowd panic toward a more refined and more contemporary layer of the same discipline. The specific frameworks a later generation of investors built for reasoning carefully about exactly how much of a given crowd's judgment is already reflected in a price, how far an individual investor's own genuine expertise actually extends before it quietly becomes overconfidence, and how large a cushion of safety a truly rigorous investor ought to demand before committing capital at all. These are the tools of Howard Marks and Seth Klarman, investors who came of age not in the era of bucket shops and telegraph wires, but in the far more sophisticated, far more informationally saturated markets of the late 20th century, and who nonetheless arrived, through their own careful reasoning, at conclusions that would have been entirely recognizable to Seneca, to Graham, and to the young John Templeton standing at his broker's desk in September of 1939. In the early 1990s, in a modest office in Los Angeles, a former analyst and bond fund manager named Howard Marks began a practice that would, over the following 3 decades, quietly become one of the most closely read traditions in the entire investment world, studied as carefully by Warren Buffett himself as by any professional money manager on Wall Street. Marks began writing memos to the clients of his firm, First Trust Company of the West, and later Oaktree Capital Management, the firm he co-founded in 1995. These were not the glossy, promotional quarterly newsletters that most investment firms produced for their clients. They were long, discursive, often philosophical essays, written in a plain, careful, almost conversational voice, in which Marx worked through his own thinking about markets, risk, and human psychology in real time, often admitting uncertainty and revising earlier positions with a candor that was, and remains, genuinely unusual in an industry more often characterized by confident-sounding marketing language. Buffett has said publicly on more than one occasion that whenever a Howard Marks memo arrives, it is the first item of mail he opens. A remarkable endorsement from a man whose own reading habits, examined earlier in this film, are famously selective and famously voluminous. What Buffett and generations of other investors found in those memos was not a set of specific stock recommendations, which Marx largely avoided offering, but something considerably rarer. A sustained, rigorous meditation on the actual mental process by which good investment decisions get made, distilled eventually into a 2011 book titled The Most Important Thing, whose very title captures something of Marx's own recurring insistence, echoed across nearly every memo, that there is no single formula or metric that reliably guarantees success, only a disciplined way of thinking that must be applied fresh to every new situation. The single idea for which Marx has become most closely associated, and the one most directly relevant to the arc this film has been building across its previous chapters, is his distinction between what he calls first-level and second-level thinking. A first-level thinker in Marx's formulation looks at a company, judges it to be a good business with strong prospects, and concludes in a single simple step that its stock should therefore be purchased. This reasoning is not wrong, exactly. It is simply insufficient because it stops one crucial step short of the actual question that determines whether an investment will be profitable. A second-level thinker asks a further, more demanding question. Given that this is indeed a good business with strong prospects, is that fact already widely recognized? And if so, is it already fully reflected or even over-reflected in the current price being asked for the stock? A wonderful company, purchased at a price that is already priced in years of future growth with no margin for disappointment, can be a considerably worse investment than a mediocre company purchased at a price that is priced in far too much pessimism. A formulation that connects directly back to Graham's foundational distinction between price and value, examined in the opening chapters of this film. Marx illustrates the gap between these two levels of thinking with an image worth sitting with carefully, because it captures something genuinely counterintuitive about how markets actually function that a purely first-level analysis consistently misses. Since a stock's price already reflects the collective judgment of every other market participant who has studied that same company, a first-level conclusion, however correct in isolation, is very likely a conclusion that a large number of other investors have already reached and already acted upon, meaning it is already baked into the price by the time a first-level thinker arrives at it. To actually outperform the market rather than simply match it, an investor's judgment must differ from the collective judgment already embedded in the price, and it must differ in a direction that eventually proves correct. A considerably harder and rarer combination than simply having a correct opinion about a company's underlying quality. Marx has put this with characteristic directness. To achieve superior investment results, your view of a company or a market has to be not merely accurate, but different from the consensus view. Because if your view merely matches the consensus, you will earn, at best, the same result the entire market is already earning. This idea, though framed in the specific vocabulary of professional portfolio management, is in fact a further refinement of nearly everything examined earlier in this film. Templeton's insistence on buying at the point of maximum pessimism, discussed in the previous chapter, is second-level thinking applied to an entire market rather than to a single stock. Recognizing that the crowd's own extreme fear has already pushed a broad swath of prices below what a careful, independent second-level analysis would justify. Munger's inversion technique, examined earlier, is itself a form of forcing second-level analysis, because asking how an investment might fail is a considerably more reliable way of testing whether one's optimistic first-level conclusion has already been fully priced in by a market full of other participants who have, in all likelihood, also already considered the obvious bullish case. Marx's second major contribution, threaded through decades of memos and elaborated at length in his writing, concerns a redefinition of the word risk itself, one that departs sharply from how the term is often used in more academic corners of financial theory, where risk is frequently equated with volatility, the simple statistical measure of how much a price bounces around over a given period. Marx has argued, repeatedly and with considerable force, that this equation profoundly misses the point of what actually matters to a real investor managing real capital. The risk that genuinely matters in Marx's formulation is not the risk of a price moving up and down along the way. It is the risk of permanent, unrecoverable loss of capital, a definition that echoes Buffett's famous first rule discussed earlier in this film, and one that has significant practical consequences for how an investor should actually behave. A stock that fluctuates wildly in price, but is virtually certain to recover and grow over a long enough horizon carries, by Marx's definition, considerably less real risk than a stock that trades with perfect calm and stability right up until the moment its underlying business permanently collapses. Volatility in this view is often simply the price of admission for the kind of patient. Contrarian investing this entire film has been describing, uncomfortable to sit through, but not, in itself, dangerous, provided the underlying analysis of genuine business value was sound to begin with. Marx has also written extensively, across memos spanning multiple full market cycles, about the specific and recurring rhythm of those cycles themselves, arguing that while it is essentially impossible to predict with reliable precision exactly when a given cycle will turn, from optimism to euphoria to fear to despair and back again, it is genuinely possible and genuinely valuable to develop a disciplined sense of roughly where in that recurring cycle the current moment sits, and to adjust one's behavior, becoming more cautious as euphoria builds and more aggressive as despair deepens. Accordingly, this distinction between prediction and preparation is one Marx returns to often, framed in a phrase that has become closely associated with his broader philosophy. He does not believe reliable forecasting of the future is a skill any investor genuinely possesses, himself included, but he does believe that disciplined attention to where the crowd's current mood sits, relative to the historical extremes of past cycles, is both possible and among the more valuable exercises an investor can undertake. What unites all of Marx's contributions, in the end, is a demand for a kind of rigorous intellectual honesty about the limits of one's own knowledge, a demand that turns out to connect directly to a concept that Buffett and Munger themselves had already been quietly building into the foundation of their own investment discipline, for decades before Marx began formalizing his own version of it in writing. The deliberate, honest mapping of exactly where a given investor's genuine expertise ends, and exactly where dangerous, unrecognized overconfidence begins. At Berkshire Hathaway's annual shareholder meetings, held for decades in Omaha and drawing tens of thousands of attendees from around the world by the later years of Buffett's tenure, a recurring question would arrive from the audience, phrased in various ways across various years, but returning always to the same underlying curiosity. Why had Buffett and Munger, two of the most successful investors in American history, largely avoided investing in the technology sector for so many decades, missing out on some of the most spectacular wealth creation of the late 20th century in companies whose products they used, admired, and in some cases praised openly in public? Buffett's answer, repeated in various forms across many of these meetings, was disarmingly simple, and in its own quiet way, one of the more philosophically significant statements he ever made about the entire discipline of investing. He did not claim the technology sector lacked opportunity. He claimed, instead, that he did not understand it well enough with sufficient confidence to reliably predict which specific companies would still be dominant a decade or two into the future, given how quickly the underlying technology itself tended to change, and how difficult it was, from outside the industry, to distinguish a durable competitive advantage from a temporary one. This admission, repeated so often and so plainly that it eventually acquired a specific name within the vocabulary Buffett and Munger built together, became known as the circle of competence. The concept holds that every investor, however broadly read and however intelligent, possesses genuine, reliable expertise across only a limited domain of businesses and industries, an area within which their judgments about value and durability are likely to be well calibrated and trustworthy, surrounded by a much larger domain about which their judgments, however confidently held, are considerably less reliable than they may subjectively feel. The discipline Buffett and Munger built around this idea was not primarily about the size of any given investor's circle, which naturally varies enormously between individuals depending on their background, their reading, and their direct professional experience. The discipline was about the honesty and precision with which an investor draws the boundary of that circle, and the willingness to simply decline to act, however tempting the apparent opportunity, once a given decision falls outside it. Buffett has offered a characteristically blunt formulation of this principle that captures its practical stakes with unusual clarity. He has said that it is not necessary to be an expert on every company, or even on many companies, to do well as an investor. Only necessary to be able to correctly evaluate companies within one's chosen circle, and that the size of that circle matters far less than the precision with which its boundaries are known. An investor with a genuinely narrow but precisely mapped circle of competence, who never strays outside it regardless of how attractive an outside opportunity might appear, will, over a long enough career, very likely outperform an investor with a broader but poorly mapped circle who periodically wanders into territory where their confidence exceeds their actual understanding. This distinction between confidence and genuine competence connects directly to a body of psychological research that emerged, coincidentally, at almost exactly the same moment Buffett and Munger were popularizing their own vocabulary for the same underlying phenomenon. In 1999, the psychologists David Dunning and Justin Kruger, working at Cornell University, published a study examining the relationship between actual competence in a given skill and a person's own self-assessment of that competence, across several different domains including logical reasoning, grammar, and humor. Their finding, which has since become one of the most widely cited and admittedly often somewhat loosely popularized results in modern psychology, was that people with genuinely low ability in a given domain tended systematically to overestimate their own performance relative to others, in some cases quite dramatically, apparently lacking the very skill required to accurately judge the quality of their own output in that domain. It should be said, in the same spirit of careful precision this film has tried to maintain throughout, that the original Dunning-Kruger finding has itself been the subject of considerable methodological debate among statisticians in the years since, with some researchers arguing that a significant portion of the observed effect can be explained by simple statistical regression toward the mean rather than by a distinct psychological phenomenon of miscalibrated self-assessment. The finding remains genuinely contested in its precise mechanism, even as the broader, looser observation it is popularly taken to represent, that a lack of expertise often comes bundled with a lack of awareness of that very lack, continues to resonate with a great many people's direct professional experience, including, quite specifically, the experience of investors watching enthusiastic amateurs confidently enter unfamiliar markets during periods of speculative excess. Buffett and Munger's circle of competence, understood alongside this research, functions as a practical working defense against exactly the blind spot Dunning and Kruger were attempting to formally document. It is, in essence, an institutionalized habit of asking, before every major decision, not simply whether one feels confident, a feeling that research on human judgment has repeatedly shown to be a poor and frequently misleading guide to actual accuracy, but whether that confidence is actually grounded in a demonstrated, track record-supported history of good judgment within this specific, narrow domain. Munger, characteristically blunt on this point as on so many others, has said that he and Buffett were not smarter than most of their competitors across the entire range of possible investments, and that their real advantage lay instead in being distinctly better at recognizing which specific decisions fell safely inside the boundary of what they genuinely understood well, and disciplined enough to simply pass, without regret or second-guessing, on the very large number of decisions that fell outside it. It is worth noting, as a genuinely interesting complication to this story rather than a contradiction of it, that Berkshire Hathaway eventually did make an enormous and extraordinarily profitable investment in a technology company, building a position in Apple beginning in 2016 that would grow to become, for a period, the single largest holding in Berkshire's entire portfolio. Buffett has been careful in explaining this apparent departure from his own long-standing avoidance of the technology sector, to frame the decision not as an abandonment of the circle of competence principle, but as a demonstration of how that circle can genuinely expand over time through diligent, patient study, and more specifically, as a decision grounded not in an assessment of Apple as a technology company in the volatile, rapidly shifting sense that had made him wary of the sector for decades, but as an assessment of Apple as, in essence, an unusually powerful consumer products company with extraordinarily loyal customers and extraordinarily durable pricing power. A type of business Buffett had spent an entire career learning to evaluate with genuine skill. The Apple investment, understood this way, is not an exception to the circle of competence discipline at all. It is, in a real sense, its most sophisticated expression. The careful, patient work of finding the specific angle from which an otherwise unfamiliar business could be honestly and reliably brought inside the boundary of what Buffett actually understood well, rather than simply chasing a hot sector because everyone else was making money in it. The circle of competence, taken seriously, produces a form of investing that looks, from the outside, considerably less exciting and considerably more restrained than the popular image of the bold, all-knowing financial genius might suggest. It produces long stretches of deliberate inactivity, entire sectors and opportunities passed over year after year, not from any failure of ambition, but from an honest, disciplined refusal to pretend to knowledge that has not actually been earned. This same demanding, restraint-oriented philosophy applied specifically to the question of exactly how much of a cushion an investor should demand against the ever-present possibility of being wrong even within one's own genuine circle of competence, found its most rigorous and most influential modern expression in the work of a deeply private hedge fund manager based in Boston, whose own book on the subject became, somewhat unusually for a work of financial theory, one of the rarest and most sought-after printed volumes in the entire English language. In 1991, a relatively young hedge fund manager named Seth Klarman, who had founded the Boston-based investment firm Baupost Group 7 years earlier at the age of 27, published a book titled, in direct homage to the foundational concept examined earlier in this film, Margin of Safety, risk-averse value investing strategies for the thoughtful investor. The book laid out, in careful and unusually candid detail for a working money manager willing to reveal his actual thinking to potential competitors, the specific investment philosophy Klarman had built at Baupost, one grounded explicitly and directly in Graham's original insight about the necessity of demanding a substantial discount between price paid and calculated underlying value, but extended and refined for the considerably more complex and more institutionally sophisticated markets of the late 20th century. The book was never reprinted after its initial print run, for reasons that remain somewhat unclear even to close observers of Klarman's career. And this simple fact of scarcity produced an unusual and widely reported phenomenon in the used book market over the following decades. Copies of Margin of Safety, out of print and never issued in a more widely available paperback or digital edition, began trading among collectors, students of investing, and professional money managers for sums that would strike anyone unfamiliar with the book's reputation as genuinely absurd for a work of nonfiction finance, with well-documented sales at auction and through rare book dealers reaching well into the thousands of dollars for a single used copy, occasionally more. Klarman himself has commented publicly, with evident and characteristic discomfort, on the strangeness of a book about disciplined value investing itself becoming an object of speculative collector demand. A small and genuinely ironic footnote to a career otherwise built entirely around warning readers against exactly that kind of speculative excess. The substance of Klarman's philosophy, stripped of the accidental mystique the book's scarcity has since acquired, centers on an idea that deepens and extends Graham's original margin of safety concept in a specific and important direction. Where Graham had emphasized buying at a discount to a calculated intrinsic value as protection primarily against the risk of simple analytical error, the possibility that one's own estimate of a business's worth might simply be wrong, Klarman placed even greater emphasis on the margin of safety as protection against a wider and more genuinely unpredictable category of risk. The risk of events that cannot be reasonably anticipated at all by any amount of careful analysis. The kind of sudden, discontinuous shocks, economic, political, or otherwise, that periodically strike markets without meaningful warning. Klarman's own investing career, which included prominent and well-documented periods of holding unusually large reserves of uninvested cash, when he judged that available opportunities did not offer a sufficient margin of safety relative to this broader category of unpredictable risk, reflects a temperament willing to accept the real, and often heavily criticized, cost of underperforming a rising market for extended periods rather than compromise on the underlying discipline. This willingness to hold cash and to underperform, sometimes for years at a stretch, during periods when a rising market makes patience look In the moment, like simple timidity or even incompetence, connects directly back to nearly every previous chapter of this film. It is the stoic discipline of accepting present discomfort in service of a soundness that only reveals its full value later, at moments the crowd cannot yet foresee. It is Templeton's willingness to be conspicuously, uncomfortably out of step with prevailing sentiment. It is Munger's inversion technique applied at the level of an entire portfolio's cash allocation, asking not what the highest possible return available today might be, but what specific, currently invisible catastrophe a sufficiently large cash reserve would allow the fund to survive, and more importantly, to capitalize on, when that catastrophe eventually and unpredictably arrives, in a manner directly reminiscent of Templeton's own decision in September of 1939. Claremont has written and spoken, across the relatively limited public record he has left behind, given his famously guarded and private approach to media exposure compared to more publicly visible figures like Buffett, about a specific and instructive asymmetry he believes underlies almost all genuinely sound investment decisions. He has argued that protecting capital from permanent loss deserves considerably more of an investor's attention and analytical energy than the pursuit of maximizing potential gain, a priority ordering that inverts the instinctive emphasis of most inexperienced market participants, who typically approach investing by asking first how much they might make and only secondarily, if at all, how much they might lose. This ordering of priorities is, in a real sense, the through line connecting every figure examined across this entire film, from the ancient grain merchant on the Alexandria docks calculating his exposure to a failed harvest, through Seneca's premeditation of loss, through Graham's discount to calculated value, through Buffett's first rule of not losing money, through Munger's inversion and his careful checklist of known errors, through Marx's redefinition of risk as the probability of permanent loss rather than mere volatility, and finally to Claremont's own willingness to hold cash and accept short-term underperformance in service of a longer, more durable soundness. What all of these figures shared, across a span of 2,000 years and an enormous range of specific historical circumstances, was never really a shared technical method for identifying undervalued assets, though the methods each of them developed were genuinely rigorous and genuinely valuable in their own right. What they shared at a deeper level was a common psychological orientation toward uncertainty itself, a recognition that the future cannot be reliably predicted in its specifics, that the crowd's collective mood will periodically swing to extremes that have little to do with underlying reality, and that the only genuinely reliable protection against this permanent and unresolvable uncertainty is a disciplined, deliberately cultivated humility about the limits of one's own knowledge, paired with a structural insistence on demanding enough of a cushion, in price, in position size, in cash reserves, in emotional preparation, that being wrong, when it eventually and inevitably happens, does not become catastrophic. Having now examined the specific intellectual tools this discipline requires, from the stoic separation of the controllable from the uncontrollable through Claremont's insistence on protecting the downside above all else, this film turns in its final part toward a different, and in some ways more difficult set of questions, ones that move beyond the mechanics of building a fortune, and toward the considerably less frequently discussed matter of what such a fortune, once genuinely built and sustained across a lifetime, actually costs the person who builds it, and what these same investors, almost without exception, eventually came to say, in their own words and often surprisingly late in their lives, about what the entire pursuit had actually been worth. There is a house at 555 Farnham Street in Omaha, a gray stucco building with 5 bedrooms, purchased in 1958 for $31,500. Warren Buffett has lived in it ever since, through every stage of a career that eventually made him one of the handful of wealthiest people on the planet. He has been offered over the decades extraordinary sums for the property and for the land it sits on, and he has declined every offer, continuing to live in the same modest house, drive relatively unremarkable cars, and eat lunch, by his own frequent public admission, at a McDonald's near his office, ordering from a small, fixed rotation of meals he has kept largely unchanged for years, washed down with the same cherry Coke he has publicly endorsed and consumed since childhood. This is not, on close examination, simple frugality for its own sake, and it would be a mistake to read it purely as thrift. It is something closer to a deliberate, carefully maintained psychological defense, built and sustained across an entire adult lifetime, against a specific and well-documented danger that great wealth poses to the very temperament this film has spent its previous 15 chapters describing. Buffett has said, in language that connects directly back to the Stoic material examined at the opening of this film, that he did not want his possessions to own him, and that maintaining a stable, familiar, largely unchanged daily life was itself a form of discipline, protecting the same patient, undistracted, reading-centered temperament that had made his investment career possible in the first place from being eroded by the countless new distractions, obligations, and temptations that an unrestrained expansion of lifestyle would inevitably introduce. Charlie Munger held a strikingly similar view across his own long life, and was, if anything, even blunter in expressing it. He warned repeatedly, in speeches given late into his 90s, against what he called the vice of envy, arguing that a compulsive need to match or exceed the lifestyle of wealthier or more visibly successful peers was among the most reliable paths to a genuinely miserable existence, regardless of a person's actual financial resources, precisely because envy is a psychological state with no natural stopping point, always capable of finding some new and larger comparison against which the self appears to fall short. This concern, stated in Munger's characteristically blunt modern idiom, is a direct continuation of a warning Seneca offered nearly 2,000 years earlier, when he cautioned against measuring one's own sufficiency against the wealth of others, rather than against one's own actual, concrete needs, observing that a person who has enough by objective measure can nonetheless be made to feel poor simply by comparison to someone who has more. The empirical psychological research into the relationship between money and genuine well-being, conducted across the same period that produced Kahneman and Tversky's work on loss aversion discussed earlier in this film, offers a more complicated and more interesting picture than either the simple assumption that more money reliably produces more happiness, or the equally simple assumption that money and happiness are entirely unrelated. A widely cited 2010 study conducted by Daniel Kahneman, together with the economist Angus Deaton, using a large survey of American respondents, found that day-to-day emotional well-being rose alongside income up to a certain point, but that beyond an annual household income of roughly $75,000 in the study's specific measurement, further increases in income produced no further measurable improvement in reported daily emotional experience, even as a separate, related measure the researchers examined, an individual's own broader life evaluation or overall life satisfaction, continued climbing somewhat further with rising income. This finding of a plateau in day-to-day emotional well-being became widely repeated in popular discussion of money and happiness over the following decade, sometimes in a simplified form that outran what the original study had actually established. A later and methodologically important 2021 study by the psychologist Matthew Killingsworth, using a considerably larger and more continuously sampled dataset gathered through a smartphone-based experience sampling method, found evidence complicating the original plateau finding, suggesting that, for a majority of people in his sample, emotional well-being, in fact, continued rising alongside income well beyond the earlier study's reported threshold, without a clear flattening point, though Killingsworth's data also identified a smaller subgroup, roughly the least happy fifth of the sample, for whom the original plateau pattern did still hold. Kahneman and Killingsworth subsequently collaborated on a joint reanalysis of both datasets together, published in 2023, which helped reconcile the apparent contradiction between their earlier separate findings, concluding that the relationship between income and happiness is genuinely more complicated and more dependent on other underlying life circumstances than either original single study, taken alone, had fully captured. The honest conclusion available from this body of research, taken as a whole, is that money does appear to matter for genuine well-being, more than a certain simplified popular narrative sometimes suggests, but that its effect is neither simple, nor unlimited, nor anywhere close to sufficient on its own. A conclusion that would likely not have surprised Seneca, who never argued that poverty was virtuous, only that wealth's capacity to produce genuine, lasting satisfaction was considerably more limited and considerably more psychologically complicated than the wealthy themselves, in any era, tend to initially assume. Beyond the specific question of day-to-day happiness, the investors examined across this film paid genuine, well-documented personal costs for the particular kind of life their discipline required. costs that deserve honest acknowledgement rather than the airbrushed treatment they sometimes receive in more purely celebratory accounts of their careers. Buffett's own family life was, by the account offered in Alice Schroeder's authorized biography and confirmed in Buffett's own subsequent public statements, considerably more complicated and at times more painful than the folksy, avuncular public image built around him over the decades might suggest, including an extended period during which his first wife, Susan, moved to San Francisco to pursue her own separate life and interests while the couple, at her initiative, remained legally married and on close, evidently affectionate terms, with Susan herself later introducing Buffett to Astrid Menks, the woman who would become his companion during those years in Omaha and, following Susan's death in 2004, his second wife. Buffett has spoken with evident and specific regret, in later interviews, about time not spent with his children during the decades he was most intensely absorbed in building Berkshire Hathaway, an admission that sits honestly alongside, rather than being erased by, the extraordinary professional discipline examined throughout the rest of this film. This honest accounting matters within the larger argument this film has been building, because it clarifies precisely what the discipline of great investors actually is and, just as importantly, what it is not. It is not a formula for a uniformly happy or uniformly well-balanced life, and none of the figures examined across these 16 chapters would likely claim otherwise if asked directly and honestly. What this discipline offers, more modestly and more precisely, is a well-tested set of tools for making sound decisions under genuine uncertainty, for resisting the specific psychological traps that destroy capital and destroy judgment, and for building, patiently and without shortcuts, a form of security that does not depend on predicting an unpredictable future. What it does not offer, and was never actually designed to offer despite how often popular retellings imply otherwise, is immunity from the ordinary, universal difficulties of being a limited human being living inside a limited human life. Difficulties that Seneca, writing from inside one of the wealthiest households in the entire Roman Empire nearly 2,000 years earlier, understood with a clarity that remains, on close reading, every bit as sharp and every bit as relevant as anything discovered since. There is a further and perhaps deeper irony embedded in this entire story, one that becomes visible only when the specific psychological discipline these Western investors built, largely independently and over the course of the 20th century, is placed alongside a considerably older tradition of thought that arrived at strikingly similar conclusions about patience, restraint, and the natural pace of genuine growth, developed on the opposite side of the world, more than 2,000 years before Benjamin Graham ever set foot in a Columbia University lecture hall. In the state of Song, during the Warring States period of ancient China, sometime in the centuries before the Common Era, a farmer grew impatient watching his rice seedlings, which seemed to him to be growing too slowly. Concerned that his crop would not mature in time, he went out into his field and one by one pulled each young seedling slightly upward out of the soil, believing this small assistance would help them grow taller more quickly. He returned home exhausted but satisfied, telling his family that he had spent the day helping his crop along. His son, alarmed, ran out to the field to look and found every seedling in the field withered and dead, the roots torn loose from the soil by his father's well-intentioned interference. This parable appears in the writings attributed to Mencius, the philosopher who lived roughly a century after Confucius, and became one of the most influential interpreters and extenders of Confucian thought in the centuries that followed. Mencius told the story of the impatient farmer of Song, specifically as a warning against a particular kind of error in moral and personal cultivation, arguing that genuine growth, whether of a rice seedling or of a person's own character and understanding, follows its own necessary pace, and that forcing or artificially accelerating that pace does not produce faster growth, but instead damages or destroys the very process it was meant to help along. The proper response to slow growth in Mencius's teaching was neither the farmer's impatient interference nor its opposite, complete neglect, but a middle path of steady, patient, consistent tending, offering the conditions growth requires: water, attention, protection from immediate threats, while trusting the underlying natural process to unfold according to its own necessary timeline. The resonance between this ancient agricultural parable and the specific psychological discipline examined across this entire film is, on close reflection, considerably more than a superficial or coincidental similarity. It is, in a real sense, the identical underlying insight, arrived at independently by a philosophical tradition with no contact with and no knowledge of the specific vocabulary of compound interest, stock valuation, or modern portfolio theory that occupies the center of this film's more recent chapters. Buffett's own image of the snowball, examined earlier in this film, and Mencius's image of the seedling, are at the level of underlying structure, making the identical claim that certain valuable processes have their own necessary duration, that this duration cannot be meaningfully compressed through impatient intervention without damaging the process itself, and that the appropriate human response to this reality is not passivity, but a specific, disciplined, actively sustained patience, offering consistent tending while resisting the powerful temptation to force a faster result. Confucian thought more broadly, beyond this single specific parable, developed an entire ethical vocabulary around the cultivation of virtue that maps with genuine precision onto the psychological discipline this film has traced through Stoicism, through Graham, through Buffett and Munger. The Confucian concept of self-cultivation, central to the entire tradition and elaborated at length across the Analects and the later commentarial literature that grew up around them, held that genuine moral and intellectual development is not achieved through sudden insight or dramatic transformation, but through sustained, daily, often unglamorous practice, repeated with consistency over an entire lifetime, in a manner that a careful modern reader will recognize as remarkably similar to Charlie Munger's own description, examined earlier in this film, of how a genuinely well-stocked, well-integrated mind is actually built, not through occasional brilliant insight, but through the patient, compounding accumulation of daily reading and daily reflection, sustained across decades rather than concentrated into any single dramatic effort. There is a further and genuinely interesting historical wrinkle worth including here, one that adds real texture rather than false tidiness to this cross-civilizational comparison. Traditional Confucian social hierarchy, as it developed and stabilized across successive Chinese dynasties, actually ranked the merchant class quite low in relation to other social roles, below scholars, farmers, and artisans, reflecting a persistent cultural suspicion that commercial activity, oriented as it appeared to be toward the pursuit of private profit, was in some fundamental tension with the more elevated Confucian virtues of public service, scholarly cultivation, and productive agricultural labor understood as directly sustaining the broader community. This historical detail complicates any attempt to draw too neat or too flattering a straight line from Confucian philosophy directly to modern investing, and it is worth stating plainly rather than glossing over, in keeping with this film's broader commitment to historical honesty over convenient narrative symmetry. The specific temperament this film has been examining, patient, disciplined, oriented toward long-term cultivation rather than short-term extraction, is not something traditional Confucian society would have primarily associated with merchants and financial speculators at all. It is something that tradition primarily associated with the scholar-farmer ideal, the cultivated individual tending patiently to fields and to their own moral development in parallel, largely outside, and to some degree in tension with commercial life as such. And yet this apparent tension, examined closely, actually strengthens rather than weakens the deeper point this chapter is making. What Buffett, Munger, Graham, and the other investors examined across this film ultimately built, across their respective careers, was not in its underlying psychological substance a commercial or speculative temperament at all, despite operating within markets that are, on their surface, thoroughly commercial institutions. It was, at its actual functional core, something considerably closer to the scholar-farmer temperament the Confucian tradition specifically prized. Patient, cultivating, oriented toward the slow tending of something whose full value would only become apparent over a very long horizon, deeply suspicious of shortcuts, and of the specific kind of forced, artificial acceleration the farmer of song attempted on his seedlings. Buffett himself, spending the overwhelming majority of his working life reading rather than actively trading, deliberately living in the same modest house for over 6 decades, rather than continually upgrading his material circumstances to match his rising wealth, resembles, in the actual daily texture of his life, considerably more of a devoted scholar tending a lifelong field of study than the popular caricature of a fast-moving, deal-chasing Wall Street financier. The vocabulary is Western and 20th century, The underlying temperament on close inspection would have been entirely legible, and very likely entirely admirable, to a Confucian scholar reading by lamplight in a study more than 2,000 years earlier, watching his own seedlings grow at their own necessary, unhurried pace. This is, in the end, the largest and most durable claim this entire film has been assembling across its previous 17 chapters. One piece of evidence at a time, from the docks of Alexandria to the Danube frontier, to a Columbia University classroom, to a preschool testing room at Stanford, to a rice paddy in the state of Song. The specific psychological discipline required to build and sustain genuine, durable wealth is not a modern invention, and it is not the exclusive intellectual property of any single culture, era, or economic system. It is a remarkably stable and remarkably recurring pattern in human thought, rediscovered independently, in different vocabularies and different specific contexts, by an ancient Roman philosopher writing letters to a friend, by a devastated stock analyst rebuilding his entire framework out of the wreckage of a market collapse, by a farm boy in Omaha reading ledgers before school, and by a Chinese philosopher warning against the specific folly of pulling on seedlings to make them grow faster. Roughly 2,000 years and several thousand miles removed from any of the others, and entirely unaware that the same essential lesson was quietly being learned, and would go on being learned again and again by every generation that followed. Return for a final moment to the harbor at Alexandria, to the merchant standing on the quay in the thin early light, watching sacks of grain come off a ship whose cargo he priced months before it ever set sail. He does not know that his particular habit of mind, patient, attentive, willing to wait for a return that could not be guaranteed and could not be rushed, will still be practiced in essentially recognizable form by human beings living roughly 2,000 years after his own death, in cities he could not have imagined, trading instruments he would not recognize, guided by a body of psychological research conducted using tools, from smartphones to controlled laboratory experiments, that would have seemed to him closer to magic than to commerce. And yet the underlying discipline, examined honestly across every chapter of this film, has changed remarkably little in its essential shape. Gather more information than the crowd bothers to gather. Wait longer than the crowd is willing to wait. Know, with real precision, the difference between a risk genuinely understood and a risk merely hoped will resolve favorably. Build in calm moments the specific structures, financial and psychological both, that will hold when the inevitable storm eventually arrives. Because it always eventually arrives, for every generation, in some new and locally unrecognizable form that nonetheless rhymes, on close examination, with every storm that came before it. In 2010, Warren Buffett, together with Bill and Melinda Gates, launched what became known as the Giving Pledge, inviting the world's wealthiest individuals to publicly commit the majority of their fortunes to philanthropic causes during their lifetimes or at their deaths, rather than passing the full accumulated sum on to their own heirs. Buffett himself pledged to give away more than 99% of his own wealth, a commitment he has steadily fulfilled across the years, since through large annual donations, primarily to the Bill and Melinda Gates Foundation, and to foundations run by his own children. Charlie Munger, across his own long life, gave away hundreds of millions of dollars to universities and hospitals, often directing the funds towards specific architectural and institutional projects he had personally studied and cared about in considerable practical detail, in a manner entirely consistent with the same close, hands-on attentiveness he brought to evaluating a business. This final turn, from patient accumulation toward equally deliberate and equally patient distribution, is worth sitting with as this film reaches its own close, because it clarifies something about the actual purpose of the entire discipline, examined across the previous 17 chapters, that a purely technical account of investing method would otherwise leave obscure. The patience, the discipline, the careful management of risk, the refusal to be swept along by the crowd's euphoria or the crowd's despair. None of it, in the end, was actually about the accumulation of wealth as a final goal in itself, however much the specific vocabulary of stocks, valuations, and annual reports might make it appear that way on the surface. It was, at its deepest and most honest level, a discipline of clear thinking and of well-placed trust, a way of engaging with an uncertain world that happened to be demonstrated, with unusually clean and unusually well-documented evidence, in the specific arena of financial markets. But that was never actually confined to that arena alone. as the Stoics tending their own inner composure and the Confucian scholars tending their own patient seedlings, in eras that knew nothing of stock markets at all, had already understood long before the first modern exchange ever opened its doors. What then does this long history actually teach a person who will never manage a hedge fund, will never sit across a desk from Warren Buffett, and may never invest a single dollar in a single share of stock across their entire life? It teaches, first, that the most valuable resource any person actually possesses is not their initial capital, financial or otherwise, but the accumulated, compounding quality of their own daily attention and daily discipline, sustained patiently across a span of years long enough for that compounding to do its slow, largely invisible work. It teaches that the crowd around you, whatever crowd that happens to be in whatever domain of life you are navigating, is frequently wrong at precisely the moments it feels most confidently, most visibly, most reassuringly right, and that the specific discipline of maintaining an independent, carefully reasoned judgment against that current, while remaining genuinely humble about the real and permanent limits of your own understanding, is neither arrogance nor timidity, but something considerably rarer and more valuable than either. And it teaches, finally, in the specific and hard-won voice of Seneca writing to Lucilius, of Graham rebuilding his shattered framework after 1929, of a farm boy in Omaha who never stopped reading, and of a farmer in ancient China who learned, through the death of his own seedlings, exactly what patience actually requires, that a life spent tending carefully, waiting honestly, and refusing every tempting shortcut toward a result that cannot actually be rushed, is not merely the surest path toward a fortune. It is, on the evidence assembled across every chapter of this film, very close to a definition of wisdom itself. The tide continues to move in and out of the harbor at Alexandria, the way it always has, the way it still does today along that same stretch of Mediterranean coast. The grain still arrives, uncertain, dependent on rains and floods no merchant can control. And somewhere in some form, a person is still standing quietly at the edge of that uncertainty, choosing once again to wait.